Good morning, everybody. Welcome to our Tuesday session. So we got quite a big show coming up today. I'm very excited about taking a look at valuation. So that's going to come with our good friend Tom in trade expectations. So stick around for that. And also, Angeline,
I'm so excited about your segment with Tom because he has got some amazing props coming up.
We've even got props to teach you PE and valuation.
So before I get to the coming up, the quiz question for today, we have a winner for the previous one, the dice one, which I'll unveil later on. The quiz question for today is, what props did Rich use and use on today's show? So you have to get two, they'll be fairly obvious. Which props did Rich use today and Ange today to show the trade strategy? So keep that in mind. We've got plenty coming up, not just Tom, but we also have the one, the only Luke Moore, PCM, who's going to come here and talk about, top trades and the action this morning, and also a bit of technical analysis, volley bands.
So yeah, volley bands, that's in confirm and send, isn't it? We had a viewer question, and Ange is going to give her expertise in how to use volley bands, which is good. I've never looked at those properly before. Right. And then finally, we also we're going to take a deep dive into NVIDIA. So that's another viewer question on how to spot a really good quality company for the long term. So I'm going to use NVIDIA as an example. So stick around for confirm and send around 8:25 this morning if you're interested in NVIDIA.
Speaking of good quality company,
is this Greg's?
No, I just had the most incredible journey in, and I thought, wow, Rich and I and the gang in there, we got it good. We have it really, really good. First world problems and everything, and
Oh, do tell.
There was a couple that looked, a couple that looked like they just started dating. And I noticed that they both looked like they'd spent the entire night crying.
Oh.
She was still crying, right? And then then because there weren't many people around, they were talking loudly, so I wasn't trying to listen, but you kind of
was this on the train, just to set the scene for everybody?
Yeah, right? and the train, and of course, it's very quiet, except for those two. And then it became apparent that they were crying because they were trying to get to a hospital.
Oh my goodness.
And she'd found out she's pregnant, but the conversation was, in between sobs, she then said, right, we need to fill out this form. What is your mobile phone number?
Oh, they were a very brand new couple.
Where do you live? What's your address?
Oh, wow. I thought I had a tricky start to the morning because I got to the tube station and I realised completely forgotten my computer for the day, which had all my preparation for the whole show in it. So I said to the guy in Pret, I said, hold the coffee, and I left my props with him. I endangered the props for the show in the hands of my kind friend from Pret a Manger, and I went running back home. Now, I'm not sure I might have mentioned it on the show before, but in my old days, I was the fastest man in Scotland. So I burned down Cromwell Road.
He is quite fit.
Was. Very much was, because when I got back to the house, then back to the tube station, got my coffee, got on the train, and was absolutely sweating profusely. So anybody looking at me on the tube station, I don't know what they would have been thinking this morning. So yeah, had to get in. I did have my red top on before because I am officially now a bear. So it was bearish red for the day. And that is because of the Powell press conference last night, right? Now, this wasn't a Fed decision, right? It wasn't that he was standing up and delivering an official speech. This was him sitting back on a chair, very relaxed, having an interview with the National Association of Business and Economics. Now, he very clearly, and Financial Times covers it this morning, very clearly said that if the data remains the same, then November will be a 25 basis point cut, right? But not only did he give evidence towards why he's going to be looking for a 25 basis point cut, him and the committee, in November? But he also started to talk about the path for the future. So that's something we're going to look at in overnight action. And then we also have the Greg's trading result coming up.
Love a bit of Greg's.
And as well as our moves in Asia overnight. So let's go straight away to overnight action.
Hey, 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 welcome back, trader friends. It's Rich and Ange here to take you through the overnight action before the open here in the UK. So what we got?
Well, the Japan staged a partial recovery, right? We saw a bit of a move back towards up 2%. Of course, it had a really poor Sunday night, Monday session because of the election result on the Friday that we broke on air just as it came into air on Friday. So Japan up 2%, India small lower, excuse me, India down 20 basis points. But I did think it was it's quite good of the FT to have given us a year-to-date change on each of those as well. So Hang Seng up 24% year to date now, right? I think that's all come in the last week, hasn't it? Yeah.
Since China Tuesday, I think.
Yeah, so CSI 300, the same. So that's the wider market over in China, up 17% year to date. The Topix is up 13%. The Kospi down 2.3 on the year, and then the Nifty 50, my old good friend, that is certainly in my pension. Nifty 50 up 18.5% on the year.
I love how it's doing so well now, because remember, many moons ago, you'd never think about trading the Nifty 50, would you?
No.
Yeah.
No, certainly not. And it's really come onto people's radars in the past, probably the past 2 years, I would say. I've my girlfriend's friend, she is from India, comes across for dinner every now and again, an incredible cook, absolutely. Big shout out to Aditi out there, brings her own spices from India.
I think what makes their curries so, like, that extra boost is they actually grind their own spices, and they make this thing called tumis, which is like a simple term. It's just, it's much paste. But then they dry fry it before they make the curry.
Wow. To
get the aroma out.
Well, the smells that come out of our kitchen, when she's over, her and my girlfriend produced these, just incredible dinners while me and her boyfriend sit and drink some great French red.
Is that what you're doing? You kind of
Frenchman.
like with your feet up. Is that what you're doing with your?
That's right. Yeah. I mean, I would suggest that we would cook for them as well, but it wouldn't come anywhere close. Maybe haggis on St Andrew's Day.
I like haggis.
Yeah. Well, you haven't seen my version of cooking it. Elsewhere, right, what do we have in Europe this morning? Well, it looks like we're going to have some strikes and protests across France, so keep that one on your radar. That's probably because the day ends in a Y. Sorry, producer Fred, our French friend. But yeah, so we've...
He said it's okay.
We've got Macron's refusal to appoint the Nouveau Front Populaire candidate, Lucie Castet. So that's also reported in the Financial Times this morning. So that looks like that could go on for a while. That's not an easy one to fix, right? This is, of course, leads back to Macron's snap election. And remember the underperformance we had in the CAC over that sort of 3 to 4 week period. So yeah, that's one to watch for. These strikes and processes could grow. They are backed by the trade union CGT. So just beware your French positions.
Also, I mean, talk about the new. Some people say he's got till end of this year. Some people say 6 months. In France, so it could all potentially boil over if they don't try and get some of these strikes under control.
Yeah.
One of the key things that we are also keeping an eye on is just the developing situation in Lebanon as well. Just taking through some of the We're going to keep an eye on that. Oil steady at the moment. As you've got a gold position just like myself, right? So I've got long, but I've also got a short. But now I think because of this,
stifled those gold bulls. Yeah. Perfect. Bit of a fireside chat. Now, Powell signalled that there is data that's come out since September Fed bumper cut that points him towards being concerned about the economy. I think two things. First of all, he thought that GDP and GDI, which is sometimes his preferred measure, so income being the preferred measure, that was coming in lower than GDP. He thought he was concerned GDP might be revised lower to meet where GDI was. It's actually happened the opposite. So GDI was upgraded. This removes some of the downside risk to the economy. His second point was that personal consumption was also revised higher. So personal consumption came in, taken away from any concerns about consumer spending. So you had a clear message that that first 50 basis point cut was recalibration. He emphasized the word. And we are 25 basis point up on November 7th, but also it's going to be 25 basis points going forward, right? This is huge different from what it priced into the market, not just for the rest of this year, but the start of next year as well. So let's take a quick look at Fed Watch. That has changed the odds for November. We can see now that it's a 65% chance of a 25 basis point cut. That was
that's a huge difference from just a couple of sessions ago.
It is, and this was fully him speaking last night. So only a 34% chance of a 25. So that's in November. However, if we go interesting one. You can see, remember, we're talking about either going to 4.5 or 4.25, right? 22% chance that we could be down at 3.5. So this, the very fact that this even talked about, the market is being dovish. If we go to March, there's a 25% chance that we're down at 3.25. So another full 100 basis points of cuts. So this has led me to believe that the market is pricing in way too much. It's now officially fighting the Fed. And if there's anything that I've learned over the past 20 years, it is do not fight the Fed. So position-wise, we can go into how that's changed my positions and the couple of trades that I did last night. We can do that just before the market open or on the market open. But it is centered not so much around stocks, but it's centered around currencies and around bonds. It's not too often I trade the bond market, but I did have a short on the 2-year Treasury last night and shorted GBP.
Yeah, I've got a short on GBP as well because after you sent me that text, the thing is and I can talk about this a bit later, mine has technicals related to it.
Ah, nice. So
yes.
our skill sets are combining and aligning. That gives me more confidence.
Yeah, weirdly, I was putting on that trade not because of JP, but I was putting on that trade because of I saw a pattern that I quite liked. So my stop is a 13435. So if you put your cursor at 13435 for cable, you're on the
right. Yeah, yeah. There we go.
And then my limit is 13250.
Okay. Yeah, 132.5. That makes sense. So you're playing for a kind of 1% on the downside.
Yes.
Makes sense.
Yeah.
Now, I think that we need a sustained recalibration, to steal Powell's word, of the market coming up to where the Fed is, right? And that's taking 3 rate cuts out over the next 4 months. Now that is significant, right? If that happens, then that will cause the dollar to strengthen, because you're talking about less rate cuts, so the dollar becomes more attractive to investors looking for a return. Whereas I'm concerned that this budget that we've got at the end of October, right, the Labour Party moving towards that budget, businesses are losing confidence rapidly, right? And we're going to have this whole period of the latter part of September and the whole of October where businesses just slow down. They're not hiring, they're not making decisions because they're waiting to see what happens. So I think the data over the next couple of months in the UK is going to slow significantly, leading to us starting to price in more rate cuts here. So more rate cuts in the UK, less rate cuts in the dollar, and I think we see a significant turnaround. I'm looking more, sub 131, 130 even.
Interesting. Mate, don't say that. I'm locked into a really nice mortgage rate, on the premise that rates in the UK will be going up. So.
Oh, well, they'll still be going up, won't they? They just maybe.
Not as
sorry,
much.
they won't. No, they won't come down as. They'll come down quicker than is currently priced into the market.
Okay, well then that's kind of good for my long-term cable. I mean, we'll see how this whole JP and what's happening in Lebanon kind of spins out. But how about gold? I've got a long, and now I've got the short as well. So
a long and a short.
Yeah,
I like that.
Short-term short. I'm kind of thinking, Lebanon on the one hand, but then also, JP and the dollar.
Well, so gold's a really interesting one. You're right. It's definitely got a two-way pool.
Yes.
So a little bit tricky to call at the moment on that one, isn't it?
Yeah. So I've got, obviously still thinking around 2750 by the end of the year. 2800's the more bullish one. But I also have, a limit at 2600, but we'll see. Greggs, I love Greggs. So I traded Greggs a lot when they came out with the vegan sausage roll.
Right. Yeah. So let's take a look at Greggs' numbers there on screen. We've got the full report.
They were stellar, weren't they?
Stellar.
Just looking at the Greggs near Cannon Street, I can tell you, business.
Well, it doesn't look like Cannon Street is a good example, because it has said the underlying sales growth has slowed in its latest quarter. So it's kept its full year outlook, but it does see sales growth slowing. So I'm not sure how the market's going to take that. Right. We'll certainly get
it has
an expectation for you on where they're going to open.
It has opened 80 something stores, so it has had this aggressive expansion.
Okay.
Right, and whilst all that is shaking out, whilst the dust is settling, I think this is just a small little kind of blip for Greggs before it starts going great guns again. I think Greggs has got a wonderful business model.
Oh, certainly, yeah.
And the fact that they have thought about attractive price points as you walk towards the till is also incredible. You know, the fact that they've got what I call the Nike factor. You love this, but you're like no longer the Nike factor.
Yeah,
in the olden days,
the Adidas factor.
The Adidas factor now, but they can actually attract not only the city workers, they attract also students, tourists, construction workers. It's across the board, and the brand is still good. I mean, a brand is still, you know, it's not tarnished by the fact that it speaks to so many demographics.
Yeah, absolutely. I must admit, I like the business. I'm just not sure
about its expansion, super aggressive expansion plan.
No, about the saying that sales growth slowing this morning. I'm not sure that'll be taken. The stock's getting called unchanged. Pre-market. So we're seeing a huge unchange. Other movers are Fraser's has tried to buy Mulberry.
I know, but they said no, right?
Yeah.
Oh.
Yeah. Unfortunately, like somebody else said yesterday. Now, what are you going to do with that right move now, Ange?
I don't know what I'm going to do. I'm staring at it, and then Awardy's like, you just need to ride it. I asked Luke as well. And Luke was just...
That's not advice, of course. That's just a personal view there from Mr. Ward.
Yeah, not advice from me either. It's just that point where it hasn't hit my stop. And essentially, I think it's a good company. I think it's got, a good thing going. Mm-hmm. And obviously, if I just thought it was just
There's a great article in I think it was the Times this morning, actually, and it's got an interview with the Murdochs, and it signals exactly why they were going for it, but also praises young Murdoch in not overpaying, because there's always the temptation to overpay. But it does say that the board of Rightmove were not willing at all to engage in any significant discussion. So this could just come back to bite them in the behind.
You think?
Yeah. Well, it signed off with something along the best of luck in the UK market as it gets more and more competitive. And I thought that's just a bit of a parting.
Yeah.
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 So,
well, my stop is at 570. I haven't hit it yet, so.
Yeah. Just a reminder, REA cannot come back and bid for Rightmove in the next 6 months unless another bidder appears.
Come on, someone else.
So if another bidder appears, they are free to come back into the picture. So that's us covering Rightmove, and then we've got the strike on the East Coast of the US as well.
Yes, we do, and I really want to talk about the story because it is one that I am watching for our trader friends out there, and also for those of you that trade a lot of retail, transportation stocks, Nike, like rich as well, because this is huge, and it actually could, if we see this impact the sector, it could potentially hit everything from packaged foods, auto parts, to shoes, retail, everything. So we'll come back to more of that after the break.
We'll see you for the opening call.
Welcome to IG's Charting the Markets, your gateway to expert technical analysis and market forecasts. Our video series breaks down the complex world of technical analysis into 3 key asset classes: indices, forex, and commodities. Watch as IG's expert analysts dissect charts, spot trends, and provide actionable insights. Whether you're tracking global indices, navigating currency pairs, or exploring commodity markets, we've got you covered. Sharpen your technical analysis skills and make informed decisions. Join us for Charting the Markets every week in IG's trading platform and on IG.com, where data meets clarity. Start watching now and stay ahead of the curve.
Forex. At its core, the simple concept of converting one currency to another. But the jargon can be confusing until you get to know it. First, let's look at the instruments that you can trade. Forex is traded in currency pairs, because effectively you're buying one currency and selling another. The currencies themselves are represented by 3-letter codes: USD for the dollar, EUR for the euro, JPY for the yen, and so on. The currency on the left is known as the base or primary currency. On the right, the quote or counter currency. Popular pairs such as the pound versus the dollar are known as major pairs. Those traded less frequently are called minor pairs. They include currencies like the Singapore dollar or the South African rand. Pairs containing emerging currency, such as the Mexican peso or the Polish zloty, are called exotic pairs. Traders also use several slang terms in Forex. For example, cable means the pound versus the US dollar. It refers to the original transatlantic cable between London and New York. You may hear names like loonie for the Canadian dollar, which has a picture of a loon bird on the coin. Then there's the Aussie, the Kiwi, and the greenback. The movement for Forex prices also has its own term. A one-point movement is called a pip. In most major pairs, this refers to the fourth digit to the right of the decimal place. So, if the euro-dollar price changes from this to this, that's a one-pip change. One important exception is when the yen is the quote or counter currency. Take the pound against the yen. Here, the second digit is the one to watch. Any extra decimal places shown in the price are known as fractional pips or pipettes. Each one pip movement is worth a tiny amount. So, Forex is normally traded in standardized quantities called lots. A standard lot is 100,000 units of currency. Small investors don't often have access to such large amounts of money. So, many Forex providers allow you to trade using leverage. This is where you can open a rather large market position with a relatively small deposit, known as a margin. Your profit and loss are based on the full position, however, and your gains and losses could far exceed this amount. So, when trading on leverage, it's important to keep an eye on the downside risk. Those are a few of the basic terms you're likely to come across when trading Forex. There are many more to learn, but understanding these should give you a good start on the road to becoming a confident Forex trader.
Hi, I'm Sean Murison, Senior Market Analyst at IG, and join us for our new show, Charting Essentials. That's every fortnight on IG.com, our trading platform, as well as YouTube. And that's a show where we look at everything technical analysis, hoping to help you upskill. Whether you're starting out or just looking to level up, we got you covered. In each episode, we'll break down complex concepts into easy to understand lessons, provide practical tips to help you sharpen your chart reading abilities, explore powerful technical indicators and their real-world applications, as well as guide you through hands-on examples to reinforce your learning. So come, let's work on our skills. Let's get better at this. Let's accelerate that trading journey. Let's have confidence to trade and make informed trading decisions.
Hey, welcome back, trader friends, and here we go, opening bell here in London, and we are just 2 minutes away from the open. Let's check out the action, Rich.
Yeah, so we got quite a few things to look at, right? We've got how Rightmove trades today, how Greg's opens, how Mulberry opens.
The pain every time he says Rightmove. He's doing this on purpose.
Also, those of you that still have Halion from the GSK spin-off, there was a placing last night. Pfizer sold 640 million shares at a price of 380. So it's 380 pence. So that's probably looking down about 2% on the pre-market indications. Then 3i infrastructure up 1%. September income in line, and Great Portland expected up 1%.
We also have, oil insight and gold as well, given the things happening overnight in the Middle East, but also taking a look at some of the indices as well ahead of the game, and we are seeing, just flat picture at the moment for U.S. tech and also Wall Street, which is Dow Jones Industrials, just a few seconds away from the UK Open. I am also watching for this continued effect after China Tuesday, because we saw that across a few sessions so far this week. It seems like an incredible thing, but we are still seeing that trickle effect go through not just car makers, but also
no more 50 basis point rate cuts. It's not a bad thing. It's Monday, September 30th, 2024. This is Overtime. I'm your host, Chris Vecchio, Ilya Spivak in San Francisco, Dylan Radigan in Milan, to take us through the rest of this hour as we wrap up the trading day. And hopefully for the Mets to close out the Braves here. Diaz, stop blowing it. We do have to focus on these markets, though. And it's a market that ultimately turns higher into the end of the session. End of quarter markup for the S&P 500 and the NASDAQ as they briefly turn their heads above water into the close. The final half an hour did see a rally here. S&P 500, as we turn to the charts, 58.14 NASDAQ up by 0.14%, Russell up by 0.11%, and the Dow Jones slightly lower by 0.12%. Until that final hour of trading, though, it was a quiet day. Powell's comments did move the market ever so slightly, with a brief pullback in equities spurred on by the whole idea that maybe we're not going to get another 50 basis point rate cut in November, which was the base case scenario. We see all the news out of China, more rate cuts, more stimulus, silver, gold, copper, they all take a break. Some really incredible news out of the Middle East this weekend. Just eye-popping headlines left and right, and yet oil still can't catch much of a bid, 0.03% higher. And then in the world of currencies, the yen, that is taking a move to the downside, still digesting the Ishiba, perhaps, results, off by 1.02%. Gentlemen, it is the end of the third quarter, though. We finish the quarter with another 4% gain in the S&P 500 for the quarter, 7 out of 8 quarters in a row in which that's happened. It also means that we had the first positive September since 2019. We're closing the quarter at an all-time high in ESZ4, not the all-time intraday high, but the all-time closing high. And so when people check their 401ks, when they get ready to see what their financial advisors were doing for them, they're going to go home pretty happy. Ilya, what's the bear case from here henceforth as we go into end of year where the market's up 20% year to date?
I think you have to look at the way that the S&P has performed the past 3 weeks. Notice that it's performed slower every one of those weeks and ask yourself why. So the biggest week that we've had was the second week of September. It was a massive rally. That was, of course, the week that the markets moved to bake in the 50 basis points from the Fed. We saw massive positioning for that bigger easing after the CPI data. So CPI data came out. It was in line. Market said, smaller cut. And then within 48 hours, they said, no, bigger, because this is what we want. The following week, the Fed delivers. Markets are happy, but the rise is shallower. This past week, China unveils all the stimulus they could possibly muster. Markets rise again, but shallower. And so you ask yourself, okay, why? Which part of this don't the markets like? They're getting absolutely everything they want, and they're getting it at a time that U.S. economic data is getting better, not worse. What's going on? And you notice that the markets read the Fed as reflationary. We've talked about this a lot. Gold has been screaming. The curve has steepened. The dollar has been lower, all of which means fewer cuts in 2025, maybe. And then we get Powell today, and he comes out and gives basically the speech that we were thinking he might give last week, where he basically just didn't say anything. And he pushed back and said, it's two-sided risk. We're not on some sort of course that's already set. We'll give you the 50 basis points we said we'll give you in November and December unless something really odd occurs. But we're not on any kind of an accelerated timeline. We don't feel like hurry. We're not cutting to address any sort of weakness. Everybody be cool. And all of this means that maybe 100 basis points is too much for next year, and maybe the markets just have already baked in everything that there was to bake in. And now we just get distribution into the end of the year.
Dylan, coming into 2024, the market was pricing in 6 rate cuts. And we heard time and again from the Federal Reserve that we weren't going to get all of the honey, all the sweeteners that we wanted. And yet, during the time when the market was pricing out those rate cuts, the equity market was still able to trudge higher.
Right.
Are we going back into a first half of the year redux, Dylan, with the super glide sitting in the control seat?
Again, I feel like there's a weird sort of role reversal because basically since, I don't know, for a couple of weeks now, I've been the one who's been more than the Vecchio let it ride Chancho. Yeah, I think we're in an incredibly good position. I think that the labor market is in a great, and the only pushback I get from the Sosnoffs and Spivaks of the world, and it's not much of a push, is valuation. No one can argue even that the labor market's great. The tech innovation sort of super cycle is intact, to say the least. The rate directionality is the right way. It's beneficial to more than the tech sector, meaning, all the sort of housing related, housing adjacent, rate adjacent things. Throw into that the Chinese money bomb and the commodities bump and all the rest of it. The only reason you wouldn't play is because you have an opinion on valuation, which is sort of where we've been. And I would say it's getting better, not worse. Meaning that the valuation relative to expectations is getting better, not worse. We're going to come in now. We're going to go into the fourth quarter. Tomorrow's October 1st. You guys gave me a bunch of Chinese skepticism last week. Don't think I didn't hear what you were saying. You're all giving me the hole in the bucket and the structural and the lack of demand. I heard you. And I'm not saying you're wrong. But I'm saying, it's not nothing. It's not nothing.
Aussie dollar says we're right.
Yeah, I mean, listen, as a euro based, somebody who lives in a euro economy, I'm happy with the euro situation. So I never complain too much about it. But, listen, there's always not always, but there's for sure some warts and some flaws, some flies, some issues. But I'm a buyer. I don't know what to tell you. I think this fourth quarter is going to be a beauty.
I think one of the interesting things to kind of build on what you just said, Chris, it took about a month at the beginning of the year for the markets to basically say the data is getting better and we're losing rate cuts, but we're losing them for a good reason. We're losing them because the economy is stronger and doesn't need as many cuts. And it took about a month for the markets to basically decide, okay, we're going to build higher on this. January was mainly spent on digestion. So if you look at what was going on there in January, you can see you hit something of a peak in, and we'll use just the S&P 500 as a benchmark, right basically at the turn of the year. December 28th is the swing high. You don't then make a new swing high until you get into the last week of January, first week of February. So there's about a month in there where things get dicey. So it may very well be that this time the markets go, well, the data's getting better. Maybe we need fewer cuts, but maybe that's a good thing and not a bad thing. It might take a while for that to kind of shake out. But of course, assuming similar timelines, that puts us right into the election and makes for us something of a different sort of atmospheric background, if you will.
This was such a strong performance for the month of September, for the third quarter. and really for the year so far, that it begs the question, how much further can the market run? Technically, obviously, you have one perspective that I've outlined, but I suppose it's worth looking at it from the quantitative side as well. It is an election year, and so while the S&P 500 and NASDAQ both have fairly strong returns, historically speaking, over the past decade or 2 decades, in the month of October, we do need to be aware of the fact that going into the election, right, depending upon which party is winning the election, the market behaves differently. So the month of October could actually be very instructive for how we anticipate that result on November 5th. Going back to 1927, going back to 1927, 1928, the month prior to all elections, when the incumbent party has retained power, the S&P 500 has gone up 1.9%. Leading into the election, if the incumbent party loses power, stocks are down negative 0.4% on average since 1928. But I want to dissect what happens in October after a 20% gain here year to date so far. This is the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10th time since 1950 that we've been up 20% year to date going into the fourth quarter. On average, October has produced a return of negative 3%. When you go into October with a 20% year-to-date gain thus far, median return is minus 2.5%. You are lower to the tune of 77.8% of the time. And that's interesting because on average, the month of October, going back to 1950, you're gaining 0.9%, going up 59.5% of the time. So the fact that we're in a presidential election year right now, when markets tend to get a little bit dicey in the month leading into it, we can perhaps read through to find out whether or not which candidate the market believes is going to win by how the market behaves into that result, depending upon the incumbency bias. But if there's a slog here in October, I don't think it should come as a total shocker. Not that seasonality was a great guide for September, at least after the first week of the month it wasn't. The first few days it was a great guide. Even so, though, if you have a bad October following a 20% September, fourth quarter returns are still positive, 2.1% on average, higher 77.8% of the time. So I guess what I'm getting at is, given the accumulation of everything ahead of us, if there's any weakness in October, it is a buy the dip kind of environment. We got all that Chinese stimmy money going burr. We have the Fed cutting within 2% of all-time highs. And even if there's a setback, which would be fairly normal here, it's not necessarily a setback that you want to sell the farm for. It's a setback that, if history is also a guide on the other side of October, you want to look for an opportunity to get long again and sell any volatility spikes that we see with vigor.
Only thing to remember here, of course, we don't have the Chinese stimulus that everybody hopes for. So far, it's only hoped for. Right? The big news in Chinese stimulus is that they're getting ready to do fiscal policy support, without which any of what they've done so far is going to work or has worked for years. This is not the first increasing of Chinese easing provisions. They've certainly done more in one shot. They did the bank requirement ratios and the headline rates all in one go this time. They usually take turns. They spent a bunch of money, or want to spend a bunch of money, on boosting stocks. Fine. But all of that is completely window dressing unless there is fiscal stimulus. And what the markets really took with such optimism last week was the idea that the Politburo is finally ready to do something like that. But there's no numbers on it, no concrete plans around it. And the whole idea that they have is that they're going to hit their annual growth target, which they're currently missing, and it's the beginning of the fourth quarter. So if they don't start raining money on this economy, basically like now, and I do mean demand generating, not just here's some cheaper credit, maybe now you'll think to actually do something. All of what we've seen out of China for the better part of 2-3 years says people are not spending and won't. Hence the 5 quarters of deflation. So the question now is where is the fiscal stimulus, and whether it'll come. And I was alluding to earlier, the circumspect performance from the Aussie dollar and the rapid reversal in copper seems to kind of reflect some of this. I mean, copper looks absolutely scary.
Yeah, copper had a fun day today.
I mean, look at the violence of that reversal. It hit that previous high. It went quite a bit of a ways higher, all around that China story, of course, and then got absolutely walloped back down. And the Aussie dollar, which should be up, hawkish RBA, dovish China. What possible reason would the Aussie dollar have for this level of circumspect waiting? It should be soaring. So the markets are suspect here, and rightly so.
Well, volatility is coming out of the Aussie. It's not coming out of the out of the copper contract yet, HGZ4, which as we frequently mentioned, probably a more tradable product than what you're seeing with silver these days in terms of liquidity, at least the futures options liquidity. It does bounce off of its 1 week moving average, and we are basically at the midpoint of the range high that you have going back to May and then low here in August, which at a 91.6 IVR. Look, volatility is really rich. This is an interesting spot to try to lay out perhaps something directionally neutral. If you had long deltas for the past 2 weeks, like some of us did, then do you want to make any adjustments here? No, not necessarily. But if you have enough time on your side, and you can get some time on your side, then this is an interesting spot, I think, at least to consider something a little bit more range bound. I guess I'm doing that as well already in the Australian dollar, where I have some iron condors put on. But we are wrapping up another quarter here where we see bonds push higher. Yes, it's a little bit of weakness here today, and we are closing well off the monthly highs in both ZN and ZB. But it's the fifth month in a row where we've seen gains in both the 10-year and long end bonds, guys. That's the longest streak that we've seen in a few years, quite frankly. I think this is one of the trades where, yeah, it didn't work out the second half of the month if you were staying long, but if you were in for the duration of the month, you saw net gains overall. That weekly chart, the monthly chart that we frequently reference, it's not as sturdy looking as it once was, but there is still compelling case for a little bit of a turn here. And it's why, if we're going to have any long bond exposure moving forward, keeping in mind the reflation trade working its way through the system, time is going to be your best friend still. And it's been that way for several months now, where if you've just been patient and riding this up, it's been working. And I think it's one of the things that we can continue to count on. Just time is going to be your friend. Maybe a sixth month in a row is hard to come by, but 5 minutes in a row being bullish, you're not going to move away from that until it breaks, and breaks very aggressively.
As a bond,
I'm looking for a little bit of confirmation, but I'm in.
Yeah, Dylan.
I mean, as somebody who's been in this with you, Chris, for a couple months, and recently, obviously, less positive than the intermediate history, with expirations rolling in October, that'll be losers down because if they're put on a September roll. Would you roll them?
Yes.
I mean, my inclination is just to keep it going. Although I'll probably bring my strikes down. Honestly, I think they're like 101s or whatever. It's a TLT situation, but I just bring the strikes down as far as I can tell and keep going.
Yeah, so right now, the way that I'm playing this, Anton and I were talking about it on Futures Power Hour earlier. So 127, 129 long call spread, a little bit out of the money. Instead of doing this as a traditional tasty 45 in, 21 out, instead treat the 45 days right now as the roll cycle before you start to even get into the part where, or the part of the decay curve where, you start to roll up the hill. So 53 days now, that would mean next week I'm going to roll out to the 88-day contract, which, having done the math earlier, if you're looking at the similar pricing, this is 127, 129, 127, 129 here, 609. You're talking about $6 and change in terms of theta burn, right? per day. If the bonds don't move and I ride this into expiry, it's going to cost me about $6 per day, max loss divided by days to expiration. The current position that I have on at this rate is about $8.25 per day. So you could just lower your risk and just buy yourself more time. It's not going to cost you significantly more. There is, of course, the roll that you have to deal with. But that's how I'm going to treat it. Anton had a really good idea there. Stop doing 45 in, 21 out. Let's treat the 45-day mark as the place to roll. And you know what? We have an 11.1 IVR. Let's take advantage of the fact that volatility is so low to get some cheap out-of-the-money call exposure. Because as we saw at the beginning of August, things hit the fan. Bonds go vertical very, very quickly. They get a ton of vol priced in. They get a bit of call skew up there as everyone bids up protection. And so those out-of-the-money calls escalate in a very handsome manner, I would presume. So that's how I'm playing it. Next week, I'm going to roll out to the December 25th expiry in the ZBH5 contract, which I can't believe we're talking about 2025 expiries then.
2030, baby. We're rounding the back nine here, heading to 2030.
Oh,
That's why Superglide, baby. Self-driving cars, teleportation. I'm looking for some teleportation in all this.
Okay.
I'm no longer impressed with the AI self-driving car.
Okay, so you mentioned self-driving cars, and I did want to bring this up because this is obviously a stock that's been flying here. Elon Musk, love him, hate him. I don't know if he has anything to do with this recent rally. We've seen a stock market that's expanded to the upside, and the rotation you're seeing is that consumer discretionary is beginning to show signs of leadership once more. And Tesla is one of the biggest components of XLY, the consumer discretionary ETF. So this is part of it. But there's the other part of this that maybe we're just going to finally get something from Tesla that we've all been waiting for. Dylan, this month that starts in 7 hours and 33 minutes should be the month that we get Tesla's Robotaxi Day. 10/10 is the fabled date. Dylan, what do we really need to see from Elon Musk on October 10th to ensure that A, this isn't something that completely clobbers the stock, and B, because he is such a modern day P.T. Barnum, we're promising all these great things about the future, and while he's working towards them, not to discredit that, you look at FSD, a lot of the dates that he's said these things would occur, they haven't happened on those timelines. They're happening,
Sure.
just not as fast as he's promised.
Sure.
Should we be looking at the 90.8 IVR here and saying, yeah, we got to sell some call spreads here because there's no way Musk delivers?
I mean, I don't know if it's a call spread. I think you definitely want to sell something, just because how are the odds that this is overhyped going in are almost just implicit in Musk's very ethos. And so I just don't why, but is it a condor? Would be my only comment. Like I would say for sure you want to be selling vol, but you might want to be wide in the condor range more than you are directional. But I mean, it's dicey to pick a direction with this thing. I gave up on picking Tesla's direction years ago.
On the consumer side, I'm a lot more excited about Nike.
Why is that?
That is a very beaten down stock that appears to be breaking out, and it's got earnings this week. So rarely do I dabble in individual names, but look on this on a weekly chart and notice that what you have here is a down move with a clear sort of line in the sand. And if you look at the latest kind of leg of this from the latest swing high there, the last time you hit that yellow line down, you seem to be trying to break out, and you have that underside there, the former bottoms. And frankly, it's one of those things where, yes, it's been beaten down a lot, but the cultural currency embedded in this brand means that it probably doesn't have too much of a hard time finding its way higher if the overall consumer story is improving. And they have earnings this week. So we might get a catalyst to actually confirm some of this stuff.
Nike is a really interesting case study of how an arrogant company totally screwed itself. During the pandemic, they decided to switch to a direct-to-consumer model where they told retailers, stores that you would go see like at an outlet mall, you don't need to have our product on your shelves. We're just going to cut out the middleman here. And that worked for a little bit, right? They cut out some middlemen. They helped beef up some margins. But the problem is that now all these retailers are like, okay, well, we need to put something on our shelves. And so all these competitors came in. And so a lot of the newer shoe brands that you see people walking around in today, they got their genesis in like 2018, 19. And because Nike decided to pull their own wares off shelves because brick and mortar was dead because of the pandemic, all these competitors came in, and Nike has been mistreated and abused by the market since then because it was an extremely short-sighted decision. They have obviously had a big leadership struggle recently where Phil Knight, Tom's talked about this a lot. Like when you have a founder that sticks around, it's difficult for the new CEO to kind of do what they want to do. And so in this case, Phil Knight sticks around at the wings and Nike can't really recalibrate yet. So I would love to see the stock do well. I suppose we should say rest in peace to Nike shoe aficionado. He had his own line of shoes. Dikembe Mutombo passed away today.
Yes, indeed.
Ilya, where we're
the legendary Dikembe Mutombo.
Wow. That's too bad.
Brain cancer, age 58. Nike here, underside of the trend line. September 2022 low, the low that we have here in April 24. We're finding resistance here. Ilya, we get through $91. This thing becomes rocket up to 98, perhaps even 100, and then long-term basing. But you know what? That makes sense. This kind of looks like it's following bonds. Doesn't this look like the bond chart a little bit?
Looks a little bit like bonds, yeah.
It's almost as if people buy more athleisure wear when they're doing well and they're comfortable because they got money in their pocket. And the economy's booming and rates are low.
As does Nike.
Right?
So there you go.
It's funny. Speaking of cultural currency, China released some, because militaries do. We do this too, but they release videos of like their fighter pilots doing things. One of the videos that they put out this weekend for like their propaganda, the fighter had a Top Gun sticker on his helmet. Like that's an American cultural victory.
Yes.
We're winning. Yes. We're winning.
Yes.
So,
if you had a Winnie the Pooh sticker on the other side, it would just be absolutely perfect.
Now this episode is going to get blacklisted in China, Ilya. Come on. All right. Let's go to Tesla. Dylan, okay, so
Mission accomplished.
We're up near the highs. We're up near the highs for the year right now in Tesla. Is this a phase?
That's why you're running call spreads at me.
That's why I want to know if we're going to be, this is the odds here. If we want to play this and play it tight, we're up near 270. We could do this with a lot of convexity and go into, say, 20 days because of the earnings announcement. I think is 18 days away. Let's see. What are we, 18 days away here? Yeah. So we can go to 25. You have to play this real tight if you even want to get a 60% probability of profit. You basically have to call the top here and saying we're not going to cross 270 anytime soon. Is this worth it to you? Risking 635 to make 365? It's actually not terrible risk to reward. There's no way Musk is gonna. There's no way Musk is gonna.
I look at this and I go, to lock in 2-to-1 the wrong way on risk reward ahead of a Tesla announcement. No thanks.
Yeah, what are you thinking, man?
I'm thinking that, he had a person up in a suit on stage and told us it was a robot.
Richest man?
Yes.
Yeah, I guess. I suppose.
Yeah.
How dare? I mean, look, this could be a very good looking chart. Boom, left shoulder, head, right shoulder. You got a big fat neckline. This could be a multi-year bottoming pattern that's coming together as it breaks a big downtrend, I'm not opposed to this. And there are those that say Tesla, you know, it's a ZERP phenomenon. Without ZERP and zero interest rates, a company like Tesla would have never succeeded. Okay, well, where are we heading right now? We're heading back to a world where interest rates maybe aren't going to zero, but they're most likely heading lower. What's one of the things that makes people want to change their vehicles? Well, outside of must turn into buying Twitter, Tesla actually didn't have that bad of a 2022 until he started running his mouth about buying Twitter. And that kind of got baked into the cake, like, oh, I guess he's going to have to sell all these shares to make good on his, you know, tens of billions of dollars share price that he promised. But Dylan, if we think that, you know, being long Tesla's almost be like being long an inflation hedge because of the electric vehicle demand. Higher oil prices, you're going to spur more of that transition. If oil prices stay low, what's the incentive? I'm paying $3.65 a gallon right now, right? That's not terribly high for my area. That's actually the lowest it's been in months. Why would I need to change cars? But point is, Tesla looks like this is coming out of a major potential bottoming effort down here. So yeah, I might want to be short term, like fade the vol short term, but on any significant pullback, I think you got to bet on a consumer discretionary company that has previously shown a high degree of sensitivity to lower interest rates, and that's the direction interest rates are going right now.
I mean, I don't think that you can realistically go out there and say, "Oh, Tesla is a flash in the pan, low interest rates story, and there's nothing else there." I mean, that's obviously ludicrous.
Okay,
And
but saying that about ARC wouldn't be.
No. No, it wouldn't.
Okay, but ARC looks like it's about to break out too. I mean, should we be watching these bellwethers, right, within the market, these high liquidity, high beta, the names that went crazy a few years ago, post-pandemic? Aren't these the names that we should be watching very closely to see if they're starting to get some action again? I mean, if ARC is going up, then you got to figure it's a good market. They've been such a dog for,
or at least that you can ride that you can ride the hype some more, which, by the way, if you can ride the hype some more and you don't get killed once the hype fades, you've done well. There's nothing wrong with riding the hype, even if you think it's hype rather than something substantive. But how soggy these markets are getting, that they're not making hay increasingly of this good news over the past 3 weeks, as we were saying at the top of the show, that is eye-catching. Things are not getting worse in the news flow. They're getting better. So why are stocks slowing? If you take a look at the latest on NQZ4, the active NQ contract, and you look at it on, let's say, an 8-hour chart, there's a little bit of technical damage starting to emerge here. So on the daily, of course, you have a bearish engulfing, but if you look on the 8-hour, you start to see a little bit of follow through. Notice we've slipped under what was the August high again, and now we're retesting that underside. We very pointedly held there to essentially say, yes, this is support now. And I was actually looking for a buying opportunity and saying, oh, well, it looks like we've corrected back to support. We're going to bounce off here. Let's maybe take a run at July's high. That's right. Memory does serve. But I'm actually back on the short side here because we've slipped back under. It didn't hold. Now, it may yet hold at this lower level. We'll see. But so far, it looks like a false breakout. And so I was able to get a cheap put vertical, very good risk reward. So let's see. If it works, it works. If not, and it turns out to hold, I'll flip long. But this is looking strangely weak need all of a sudden.
Dylan, I want to paint the exact opposite picture for the bulls.
Let's do it.
Us out there. Okay. Line in the sand is 20,000.
Let it be good.
251 and a quarter. Look, we almost have a bullish engulfing bar on the 8-hour time frame at the lows of the recent pullback. You might want to call that a key reversal. It's within the flow of the EMA cloud that's been carrying us higher ever since we turned after September 11th. So we're still poking our head above there right now. This has been a really nice correction in momentum. Okay, price, the last time we were at these levels, September 24th, we were way more overbought. So momentum is eased off. We've taken our foot off the throttle. We're not as overextended. Where's the action to the downside right now? Dylan, that's a left shoulder, a head, a right shoulder. We could be poking through that neckline after breaking the downtrend. Yeah, I still have my calls. I think I'm gonna hold on to the calls here. There's no reason not to hold on to calls for S&P, for the NASDAQ.
I mean, if you believe in engulfing candles, the bearish engulfing on the daily is a lot more convincing.
Why are you not gonna, like, how can you not be? I guess the only reason I just don't understand how you get short. I don't understand. I can understand not getting long on valuation, but I can't imagine how you get short.
That makes me that much more confident. The more out of consensus it is, the more likely it seems that it's going to work.
Look, there is a,
unless of course it won't. Then I get kicked in the jaw again.
Look, no, there is an argument to be made that this is a market that's a little bit long in the tooth, and I'm trying to pull up the data here right now. Because if we were to take a look at the positioning report, where are you?
While you do that, by the way, I am also now short
do that, please.
European index as well. So there, no vertical. I just bought an outright put on EZU, which is the ETF that tracks those markets. In euro terms, they're reversing at the high, the Euro Stocks 50, which is the benchmark for Eurozone shares. Makes sense. I would imagine the data out of the Eurozone has been absolutely god-awful. And so I'm looking not just for a top in U.S. markets here. And by the way, I'm not dabbling in S&P or Russell or anything. This is a purely NASDAQ sort of adventure. And it is, of course, the one that hasn't made its July high. It's just cleared out where it's been in August. That one's been lagging. So I'm looking for that, but also for Europe to basically give us some unwinding as well.
What were we looking at here? Okay. Speculative positioning in the futures market. This is the most, that doesn't look right here. Nope, that's not doing it what I wanted to do. The data series didn't download right. Dang. All right. Anyway, we're starting to get a little long in the tooth. I'm going to have to prepare this visually for tomorrow. I'm trying to make sure this works so I don't say the wrong number. But when you look to the CFTC's COT report, speculative positioning is starting to get to levels that are near highs last seen in December 21, which December 21 was an interesting time because the NASDAQ peaks in NASDAQ of November 21. Fast forward. Now it's January 22. The S&P 500 peaks. What was it? January 5th, I think. It was the first Wednesday of the year that the S&P 500 peaked when we got those FOMC meeting minutes for December. And the market's like, oh, they're not kidding. The rate hikes are coming soon. Okay. And then, we got the first rate hikes in March 22. But that was that first week of the year is how we top ticked the market. I bring all that up to, say that positioning, we want to make a case for the market having been up by 20% year to date, typically when you're at that strong going into October gives you a setback. You have enough positioning in your pocket to at least say this could be a place where the rally slows. But I wouldn't be placing bets beyond that, Dylan, right? If you want to place a bet that the rally is going to slow down here and we're not going to keep going at a clip of 4% a quarter, we may have
it's been slowing,
that's the bet.
For 3 weeks now.
The rally's been slowing for 3 months from my perspective. We haven't gotten really anywhere since June.
Sure.
Which is also one of the reasons why I'm looking at these breakouts and saying I think we're just getting started. Yeah, we've come a long way fast in like the narrow time horizon of the past 2.5 weeks, but we've really done nothing for the better part of 3 months. So really, that's all these conversations are, right? People with different time horizons are arguing about their perspective, when in reality, there may not be any significant disagreement. Dylan, oil here. What the heck is going on in oil, man? We have Israel killing more
They caught
people.
on. They don't even care
Keep
anymore.
falling.
They don't even care.
We're killing
it going.
more people on the United States' most wanted terrorist. Israel has killed as many people in the United States' most wanted terrorists in the past 13 days as we've eliminated in the past 20 years. There is a sense that, is this escalatory? Is it de-escalation through escalation? Look, I'm going to say something totally crazy. When the Allies had Hitler cornered in his bunker and he offed himself, I don't think there are many people sitting around saying, "Oh, is this escalatory? Like, what's going to happen now that they killed the leader?" Right? You cut off the head of the snake, it should bring the temperature down in the room. Iran's talking about getting back into a nuclear deal because they realize that perhaps their tentacles are perhaps going to be rolled up. Israel seems to be rolling up all of the Shia militias now. They're in Lebanon. They are perhaps moving into Syria, Iraq with some airstrikes. They're obviously hitting Yemen with some of the headlines yesterday. These are all things that should bring us to the precipice of World War III, is what I'm getting at here. And oil keeps hitting snooze on the alarm clock, Dylan.
Tells you
what is going on here?
So this, like I said,
World War III thing.
I mentioned this last week. When I remember we talked about NVIDIA, and we was like, oh, NVIDIA didn't do anything on earnings. And is it because NVIDIA stopped performing? No, it's because the street figured NVIDIA out. And I think the oil traders have caught on to our little game over here. And they're like, you know what? We're not going to bid oil on wacky military things. And I would even go so far as to say that the oil traders are sending a signal that the sort of taking the head of the snake strategy has worked, and that there is less geopolitical risk today than there was 2 weeks ago. That it's not an amplification of a spiral of risk, that it was a very effective assassination campaign, whatever you want to call it, and it reduced risk. I mean, that's what the oil market is saying, one way or the other.
Dylan, call me
It
old-fashioned.
certainly looks that way.
Well, call me old-fashioned, but I think the world's a less risky place when there are fewer terrorists who are killing and maiming civilians walking the planet. I know that's a wild thing to suggest, but the world's a safer place without people like Nasrallah or Bin Laden.
That's all. I understand. But I mean, the risk, the perceived risk in this sort of behavior is the degree to which it engenders sympathy and escalation from those who would be sympathetic or ability to or have the ability to escalate. And so I would say it's for sure what you're saying is true, but in addition to what you're saying, has been done in such a manner, so comprehensively and precisely and effectively. If this really sort of settles in and ends up being what it appears to be, this will become one of the most legendary intelligence / tactical military campaigns ever.
Well, and you can sort of see what's going on, right? Israel obviously lost a tremendous amount of cachet and needed to rebuild its deterrence after October 7th. It needed to continue to demonstrate to its various adversaries that it is not to be trifled with. And that was obviously an image that was tarnished significantly by the allowing of October 7th to have occurred in the first place. And so what they're doing here is putting on a clinic of basically showing, look, our deterrence should be very firm. Look at what we can do. And from the market's perspective, as ever, this is a very simple calculus. Does any of this create supply disruption risk for oil? And what the market is saying here is no. And I would argue the reason the market is saying no isn't because it's, cheering the assassination of this terrorist or that. That's a separate question. I think it's looking at it and saying Iran is not going to do a thing about this. They are not going to go into direct conflict with Israel over this. If anything, this makes Iran less likely to do so. The Ayatollah is sheltering somewhere hidden now because apparently Israel can strike in Tehran, as they showed with Ismail Haniyeh. Apparently, they don't have any red lines about hitting high-level Iranian militia leaders like Hassan Nasrallah. Apparently, they have every capacity to find these targets where they are, no matter where they are. And so, to the extent that this makes supply disruption risk less likely, because Iran doesn't want this fight, as they've signaled repeatedly, why should crude oil go higher?
There were some headlines here just to provide some historical context about what was happening over the weekend. Israel has moved, as of the past hour or so, has actually moved into southern Lebanon, going back perhaps occupy part of the country that they lasted in 2006. This is not really escalatory, in my opinion. And it's not escalatory because for the last 20 odd years or 18 years, there has been a UN resolution 1701, that basically ended the last war. And the stipulation was that neither Hezbollah nor Israel would take up any presence in southern Lebanon south of what's known as the Litani River. Obviously, if Hezbollah has been firing rockets at Israel from southern Lebanon, they've been south of the Litani River. And so Israel's moving in there to effectively say, Lebanon, you didn't hold up your end of the bargain. Part of the resolution is that you guarantee the security of southern Lebanon, so neither us nor Hezbollah occupy the area. Maybe this means you're going to get some UN peacekeeping force in there. The U.S. obviously had a peacekeeping force in Lebanon in the 1980s. That's how Nasrallah and Hezbollah killed all those U.S. Marines. This has been an ongoing issue for decades. But unless Iran steps things up right now, gotta say, I really don't have a problem watching the Ukrainians deplete the Russian army and the Israelis neuter the tentacles of Iran. Well, we just sit at home and watch our equity markets go to all-time highs. It's not bad.
And it's interesting, though.
I'm not mad at it.
I mean, I guess, yeah. Well, I mean, for sure, I agree with what you're saying in terms of, the humanity of it. I do find it perplexing that oil was very aggressive in all those spikes. You can see in the chart you got in front of us, where you get the sort of look at that big run up in March, and then it comes under, and then I guess there's that big June run, and it rolls over. And then even to August is sort of jamming around. And then even this most recent run up, right? This early September sort of autumn, recovery off of those lows. But the fact that there was the level of and the magnitude of the military activity, which inherently could imply all sorts of, like if I was to tell you that Israel was going to unload X million, however many pounds of, or however many kilograms of explosive material outside their borders in Lebanon, and tell you that it would be done in such a way that the perceived risk to the energy markets is lower prices and more secure flow of oil. I mean, that's a long odds scenario, but clearly that's what happened. Pretty cool.
Yeah.
So I guess, I guess the thing that I'm having trouble reconciling myself, because the short puts have been working and they've sucked the past few days, but they're back to break even more or less. And if it is a positioning rebuild trade, then you have to kind of approach short put spreads in oil in a similar methodology that you're approaching bonds, right? You got to give yourself time. And then you just want to be strapped in on the runway for eventually when the plane decides to lift off, which it looked like it was lifting off a few weeks ago. We've obviously come back in then. But if we can't rally on these Chinese headlines, right? If we can't rally on the Chinese stimulus headlines, if we can't rally on U.S. GDP data, we can't rally on improving U.S. growth data. We're still, what's the Atlanta Fed right now? Their last update is government website. Please load 3.1%. New York Fed nowcast is 2.99%. I mean, growth is good. China looks like it's maybe rock bottom. Oil can't get a lift. Dylan, I mean, is this just now sell on rallies no matter what?
Well, yeah, but that I'm good now. I mean,
no matter what.
I'm questioning myself because the whole year I've been like, listen, I don't know what oil's going to do. I don't know what oil's going to do. I just know when there's escalation and there's a bid in oil, buy the puts, sell the calls, whatever the angle may be. This is the first time since we've been having the oil conversation this year, of 9 months of it, I suppose, where super escalation or super high levels of activity, maybe ultimately de-escalatory in nature, but a huge amount of activity, and an oil non-response in the face of what is a declining market. I'm like, now I want to buy it.
Now you want to buy it? Oh, maybe someone in the chat can tell us. We didn't even say hi to everyone that was watching on YouTube earlier. But we didn't even say hi to everyone that was watching on YouTube earlier. If you're watching on YouTube, tell me, what's the bull case in oil? Is it the fact that is this a game of 40 chess that everyone is expecting it to rally and it hasn't? So now everyone's like, oh, naturally, then it's going to go down. But if everyone's expecting it to go down because positioning is already so thin, then it's got to go up.
Weather, I would say. There's a lot of speculation that this is going to be a colder winter in Europe in particular this year. We've gotten lucky the past 2 years. Their nat gas inventories are full ahead of this one, but speculation is this year might be much, much colder, and I suppose that could be an energy use story. Maybe.
And I'll add to it a stronger than anticipated economy, perpetuating itself, base economic activity.
Having said that, I'm still short oil, and will hold until the price action says that it is done.
I don't know.
I mean, my argument, Ilya, is if it won't rally on the whatever that we need to give a nickname to this Operation Snake Chopper, or whatever you want to call this Mossad situation,
Operation Whack-a-Mole.
But Operation Chop a Snake, if that doesn't create a bid in oil, what will?
Right. No, I agree. That's why I'm staying short. I look at this and I go, okay, the economy is reaccelerating. China stimulus, if you buy it, is a good thing. Rate cuts, if you buy that's still a thing, is a good thing. And by buy it, I mean whether you think there's still room in that story to get further baked in, and it's not all the way baked in. If all of that can't get you higher oil with the geopolitics, how is it supposed to go higher?
On
Guys,
the other hand,
all right, Dylan, last word.
No. I mean, no. I was just going to say something slightly smart-ass, but we could all anticipate what it might have been, and you're trying to do your job, so I'm going to be quiet.
No, I really wasn't. I was going to do something snarky.
You just don't want the show to end so that you don't have to go back to the reality of the Mets. You've had a 1 hour.
That's where we're going to end, actually, with our chart of the day for everyone out there. That's the win probability of our New York Mets here, folks. Looked like we were going to win, then it looked like we really weren't going to win, and then we won. Dylan, we made the playoffs. All is well in the universe.
Wow.
This never happens, particularly against the Atlanta Braves. The Chipper Joneses of the world have been haunting my life. We have a particular expression that starts with the F word.
Your hair has become much more relaxed. Your hair's calmed down. The follicles on your head are more at ease.
Yeah, it's good. It's good. It's great, actually. And yeah, overtime's out of time. We'll be back tomorrow, same time, same place. Every Monday through Thursday here on Tasty Live, 4 p.m. Eastern, 3 Central, right after last call. For Ilya Spivak in San Francisco, Dylan Radigan in Milan, I've been Chris Vecchio in New York. After a brief break, Tasty Live at Night continues. Ilya Spivak up next with Macro Money.
See you there, everybody. The last 3 months of the year are upon us. Third quarter is in the rear view, fourth quarter is getting started, and we are seemingly primed for perfection in financial markets. This is Ilya Spivak, head of global macro here at tastylive, and this is Macro Money. We're going to take a look at what we might expect in this first week of the fourth quarter and whether the markets have seen all of the good news that there was to see and price into the markets, and what that might mean going forward. Unpacking the key event risk here for the week from the macro side of things and what it might do. But first, looking at how we performed last week and what kind of context that gives us going forward. So let's begin here first with just a sense of the backdrop here. And to do that, we'll jump off from last week's performance. Stocks again inch out some gains, 0.5% on the S&P 500, 1% on the NASDAQ. We get an interesting response here from yields. They continue to give us a little bit more strength at the long end and a little bit softer performance at the front. So the curve steepens again, anticipating essentially a bigger spread between rates in the future where they're higher and rates now where they're lower. Crude oil has a massive week down, but it continues to march to the beat of its own drummer here, not really following the macro narrative, down 4%. Interestingly, despite the ratcheting up of tensions in the Middle East, gold up, the dollar steady, and the yen a little bit higher after we get a leadership change for the LDP, the ruling party in Japan. They had a leadership contest after the Prime Minister Fumio Kishida resigned amid record low approval numbers, and they had the contest for who's going to replace him. And the guy that emerged is Shigeru Ishiba, who is relatively supportive of the Bank of Japan's rate hike campaign, as opposed to the other candidate that made it into the top of the contest and was actually suggesting that maybe the BOJ is doing the wrong thing. So since we got a little bit of a more supportive administration given the options for the BOJ here, the yen seemed to have eked out a gain. The interesting part about all of this is really the momentum. So you'll notice, of course, week to week, the S&P, for example, up 0.5%, having been up 2.4% the prior week. NASDAQ, similar story, up 1%, having been up 2.6%. So the vigor with which this is occurring seems to be slowing, which, of course, is interesting given that the impetus from economic and market developments ought to really be giving us something much more convincing. In fact, if we take a look at the S&P 500 here just as a benchmark for overall risk appetite, what we find is that momentum has been slowing for 2 consecutive weeks now after this strong recovery in the second week of September, after, of course, a brutal start at the start of September. A sharp sell-off here, then swift rebound, slow down. And that things are indeed slowing and that they seem to be running into similar levels of circumspect price action as they did back in July. This is, of course, very similar territory to have found a lack of conviction. That seems curious, considering the markets have only had more reasons to go higher, it would seem. So let's look back. Second week of September here. This is the week that the markets really start to position for that Fed policy announcement. This is where they move to favor a 50 basis point cut. And so you get this strong upswing in sentiment. We can see that the subsequent week is where we actually get the Fed cut. The Fed endorses all of the market's dovish myth-making. It says, yes, you will have a 50 basis point cut. Yes, you will have 50 more basis points in cuts over November and December. Yes, you will have 100 basis points in cuts next year. Almost as much as you've been asking for, shy by less than a full rate cuts worth. Markets are slightly tilted toward 5 cuts next year. The Fed is saying 4. So the Fed does all or nearly all of the dovish reversal that the markets want of them, but momentum slows. Then last week, on top of all of this, we also get somewhat better U.S. economic data. GDP is revised higher, jobless claims come in softer, and that's, of course, good. Lower jobless claims means fewer people are filing for unemployment benefits. This is one of those indicators that you want smaller, not larger. And, of course, China rolls out a huge, expansive stimulus effort. It is on the monetary side when it comes to specific measures, which hasn't been effective for a few years. They've attempted this before, but crucially, there is an announcement from the Politburo, the core 24 members of China's ruling elite actually steering day to day, including the president, Xi Jinping. They have a special meeting on the economy. They come out and they say, we're prepared to do fiscal stimulus, finally. So not just lower rates, we're prepared to push demand through the economy, which, of course, has been the main issue and the reason why monetary measures haven't worked before. You can make it attractive for people to borrow, but if they don't want to borrow, they won't. And if they don't want to spend, they won't. And, of course, in China, you've had 5 consecutive quarters now of deflation, which means the price of everything is falling economy-wide. And the reason it's falling is, of course, there's no demand, so everything's on discount. As tends to happen when nobody is buying things, those things are discounted to try to get them spurred on to clear inventories and get things moving. That hasn't happened in China, and the hope is that what you would do with fiscal stimulus is actually start to push some demand through the system. This is a very meaningful head change for Beijing officials. They've been very resistant to fiscal support before, and yet the markets can't seem to accelerate, which is a bit strange. And one possible reason why this is happening could be that the markets have judged the Fed's actions as likely to be reflationary. We can see that all across the markets, but of course, very tellingly on display with what's happened with the recent move in the bond market's break-even rates. These are inflation expectations implied in U.S. Treasury bond yields, taking the difference between nominal yields and the inflation-adjusted TIPS yields. So we can see here from the beginning of September, inflation expectations have been on the rise, because the markets are seemingly saying you are doing these rate cuts and you are providing stimulus to an economy that isn't in dire straits, to an economy that's growing at a reasonable clip. And what all of this will do is it will reignite inflationary dynamics. So inflation expectations have gone up. In anticipation, gold prices have gone up. In anticipation, the 10 to 2 year curve has steepened, as if to say interest rates in the future will be higher as a consequence of these cuts now. So we'll see the front end rates lower, but that will mean higher rates downwind. This, of course, is exactly what we saw again in the yield structure. Notice last week, the long end is higher by 2 percentage points more than the front end. And in this most recent week, the front end is actually down, but the long end much better supported. So this steepening is saying there is a reflation situation in the works. And what we've seen here in the way that the markets have benchmarked what the Fed will do with that information is we've seen, of course, the 50 basis points earmarked for this year for November and December. That has been very steady here. But the overall tally of stimulus in the pipeline since the Fed's 50 basis point cut, here's the cut right here, it's actually reduced further. And that's been because the outlook for 2025 has become slightly, albeit, but nevertheless, less dovish. In fact, we are currently expecting 115 basis points in cuts next year. So that's about 4 cuts and a 50-50 shot at a fifth. Compare that with where we were when the Fed met and we were looking for a full 123 basis points. Go out to the beginning of September, and the peak there was 143 basis points, implying not 5, but nearly 6 cuts next year. That was as of September the 11th. So what we're looking at here seems to be a somewhat cautious, but nevertheless a rethink of what current economic dynamics mean, whereby we've seen the market say, okay, the Fed's going to do all this stimulus, but that's reflationary for an economy that isn't in some sort of a negative growth bad state. And what this will mean then is the stimulus will get inflation higher and will mean higher rates, or at least a higher floor on rates. The Fed will still cut in this sort of maintenance fashion, but the amount of rate cuts on the menu for next year might well be too many. We saw a little bit of this from Fed Chair Jerome Powell when he spoke earlier today, and essentially admonished markets, saying risks are two-way here. They're not one way. We haven't gone from only focusing on inflation to only focusing on the labor market and boosting growth. Now we are in a state of balance where we're worried about both to a relatively equal measure. We're not in a hurry to cut. We're not cutting because the economy is in a bad shape of some sort. We're cutting because we think we've hit a pathway to our inflation target, and now we can start to reduce rates such that real interest rates don't spiral out of control as inflation expectations fall and give us an unduly tight cost of credit that then puts the economy onto some sort of painful path. So what the Fed is arguing here is they're cutting rates for maintenance because the inflation fight is working or has worked. And what they're not doing is trying to respond to some sort of negative outturn, all of which feeds this reflation narrative and the idea that that rates may not need to go down to the extent that the markets anticipate next year. Now, this isn't necessarily bad news for stocks. Notice, as a matter of fact, at the beginning of the year, after about a month of digestion at these dovish extremes for policy expectations, and stocks stalling through that digestion, we then see the stock of rate cuts reduced, but stocks keep going higher, nevertheless. And the reason is because this dilution of the dovish narrative comes for good reasons. The economy is indeed doing better, and markets reason, well, we don't need as many cuts in this environment, but that's not bad for stocks. It's good for the economy, which is in turn good for earnings. So it's not as if stocks can't go up if the outlook gets less dovish. However, this is a little bit different at this stage, and this chart from The Economist seems to underscore perhaps why. Notice these are all of the rate cut cycles since basically the advent of the modern financial system, going back to 1972, right as the U.S. unpegged the dollar from gold and the modern era of floating exchange rates and fiat currencies is born. Notice what this looks at is every rate hike cycle as relative to how much more interest companies have to pay when rates go up. And of course, this is why people worry that a rate hike cycle will slow the economy, because it will be more onerous for companies to pay down debt. They will invest less in growth and in hiring and in new business lines and in whatever it is that they're doing. That will be a slowdown of economic activity. And of course, from the Fed's perspective, that's exactly what they want, because they want to take inflation out of the system and cool things down. But typically that comes at the cost of economic growth. And that hasn't happened this time so far. But note, this tightening cycle is also unique amongst all of the rest, in that not only did we not get an increase in outlays by companies on interest payments because of these higher rates, we've actually seen a decrease. Now, how might that work? Well, we've, of course, just come off the COVID-19 pandemic, and through that pandemic, interest rates went to rock bottom levels and companies hoarded cash. They, of course, also had much less to do with extended economic lockdowns across much of the world. And so they also saved a ton of money. But those loans tend to be on something of a 3 to 5 year refinancing cycle. So we've not yet seen the Fed's rate hike impact on companies' credit cost outlays. It is happening with a delay this time, uniquely amongst the other hiking cycles. And that may very well mean that we are now lining up for a situation where, just as we might be seeing some reduction in expected rate cuts from the Fed for next year, we also have a refinancing cliff coming up, which represents something of a delayed risk to economic growth if it were to materialize. And so, not surprisingly, when Powell issued his pushback in his speech today, stocks got a little bit soggier, the US dollar came up, and the markets clearly responded in a risk-off fashion, which sets off an interesting backdrop for the economic data due this week. First, we're going to have the ISM economic activity surveys. Note, they're looking to give us fairly steady sailing here. The services index seen growing at a clip equal to that of August in September. The manufacturing sector seen contracting again. As ever, this is in the logic of PMIs as it would usually exist. And so above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Both look like they will maintain pace in September, the contraction in manufacturing and the growth in services, giving us basically a steady economic picture. It's similar when we look at the all-important employment report due on Friday. 145,000 jobs expected to be added to non-farm payrolls, which is a barely noticeable acceleration from the 142,000 added in August. Jobless rate seen holding steady at 4.2% for the third consecutive month. Again, steady. This, of course, echoes the PMI numbers that we got out of the US last week, which suggested much the same thing, where we had the third consecutive month of growth, give or take, where it jumped to sitting at in May. And when it did, that was a 12-month high. So May, there was a leveling up, and then June, July, August into September, things have been basically steady at those levels. And so we're getting a story of an economy just kind of marking time at its current setting. That seemingly has given an opportunity for expectations amongst economists to adjust, such that whereas we were, as recently as late August, significantly undershooting or tending to undershoot on U.S. economic data outcomes relative to forecasts, looking at this data from Citigroup, now we're almost back to zero on this index, which is to say we've basically seen reality and expectations lining up, suggesting that, again, we have something of a steady story here and an economy that's seen data improving relative to forecasts, if only in relative terms. Nevertheless, it is a positive sort of development, all of which suggests that maybe we get somewhat warmer outcomes on this jobs report and the ISM numbers, and maintain, well, maybe we don't need aggressive rate cuts next year. Maybe 100 basis points is too far. And if it is, then maybe we need to reprice for even more reflation, but also to take away some of those cuts from the outlook. And the response to Powell's speechifying today around this idea here seems to have suggested that indeed that would not be good news for stocks, but might very well be supportive for the US dollar as its rate structure starts looking a little bit better relative to other currencies. Further helping the dollar along might very well be what comes of the situation outside of the US. And this week, that story is mainly going to come from the European side of things. And here we're looking at the incoming September CPI inflation data from the Eurozone. The expectation is that we are going to get another 3-year low on CPI. It is seen growing just 2% year on year. That's in line with the ECB target, of course. Now, importantly, they shoot to meet their target in the medium term. So 1 month at the target is not exactly equivalent to declaring mission accomplished on this. But nevertheless, this is an important deceleration here. And against this backstory, we also have here a situation where not only is this downtick in the offing, but the tendency for data out of the Eurozone has been to undershoot. And this vast move lower in the surprise index after, as we can see, an extended deterioration going all the way back to March or April of this year, this loud spike lower most recently comes courtesy of absolutely abysmal PMI numbers last week that showed that we saw not only still anemic manufacturing, but increasingly soggy services, which gave us an economy that unexpectedly shrank. We can see the composite index for this slipping back under 50 and saying that for the first time since last year, economic activity in the Eurozone contracted in September. That, of course, sets up a situation where maybe the CPI data is going to be soggier, and maybe that gives us more ECB rate cut expectations. We're currently baked in for about 50 basis points more until the end of the year. Weak CPI data might make that look light, give us a bit more of a dovish setting here, which of course comes at a very auspicious time for the euro as it hovers right under 112.50 here, basically retesting the previous swing high and very conspicuously stalling at it. So if we can get that dovish readjustment, then we likely see the euro push down, maybe take out 111 and start approaching the bottoms of this range here around 110.50. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go thereafter. I'm back on with Chris on Fridays for Futures Power Hour, on with Victor Jones for The Price of Truth on Wednesdays, back with Victor and Tom for First Call on Sundays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter, at Ilya Spivak. Thanks very much for joining. Macro Money is back tomorrow.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace. And with me, of course, the one, the only Frank Caberna in the house.
Glad to be here, man. What's going on?
Oh, man, you're pulling like a double shift, Frank. I saw you.
Is it still Monday?
It is still Monday.
Okay.
It's 4:30 p.m. Central Time for anybody that's tuning in. If you're rocking with us on the YouTube live stream, hit us up in the chat, by the way. I guess, what do you want to know? What people are up to,
Actually,
where they're from?
I do have a good question.
Favorite candy?
I do have a good question. We did just out here, a group of us, top movies of all time.
Top movie, okay.
And my top movies got everyone really angry. I'm not angry, but they were making fun of my top movies.
Okay.
I'm a big
incited some violence. Your
I'm a big
movies did?
Scorsese and P.T. Anderson and Quentin Tarantino guy.
Okay.
And so I had Pulp Fiction in there. Great movie.
Yeah, hell yeah.
Goodfellas. Great movie.
And the desk, they didn't like this?
There was like some grumbling
like
about
Marvel,
Goodfellas.
Avengers,
they were like,
or
"Oh,
some
it's
shit?"
Casino." That was honestly my joke exactly.
Yeah.
And then I dropped a Boogie Nights on them.
Okay.
And they were like, Boogie Nights, oh my gosh, that's so ridiculous. And some people were saying like, oh, Dark Knight, or like these Marvel movies, or I'm like, dude, Boogie Nights is an amazing
Is that number one in your book?
movie. It's in the top 5.
It's up there.
It's in the top 5. I think I might have to go Goodfellas number 1. That movie's unbelievable. So yeah, if you got a favorite movie, throw it in the chat. Or
Grumpy Mike, Kill Bill. Hell yeah.
Kill Bill's
That's a good
great.
one. Yeah.
I love Tarantino. Absolutely. But yeah, to be like Boogie Nights is unbelievable. I mean, There Will Be Blood, another P.T. Anderson movie.
Man, there's just too many.
It's so good. I don't know. What would you say? A top movie?
Man, you put me on the spot like this, Frank.
That's
You put
right.
everybody in the chat on the spot. Top movie,
Yeah.
Joe Dirt. All right, throw your top movie in the chat. We've got a lot to talk about here today. Frank, I saw you outside on the street. I alluded to your pulling a double shift here today. I saw you out walking the street at like 6 a.m. this morning as I was taking my dog out. You are doing a new show.
Yes.
First thing in the morning, at least here in the U.S., but this is a global show. This is for people everywhere, wherever you might reside.
Sure.
What time does that kick off for anybody that wants to watch you tomorrow morning?
6:30 Central Time, 7:30 Eastern.
Okay.
And Pacific, I don't know.
4:30.
4:30.
Yeah, if you're up at 4:30 a.m. on the West Coast.
It's a 30-minute show.
Tune in.
We're the warm-up act for Tom and Tony. Tom and Tony come out, and Vanetta, of course, as well. But those two guys pull a 3-hour set every day, Grateful Dead of the network.
Yeah.
And I come out with a tight 30 minutes with Pete Molmat. right before them. We're the opener.
And the closer here towards the end of the day.
And the closer here with Tasty Crypto on Mondays. But yeah, it's cool. Check it out if you're up that early in the morning and you want to see what is moving, mainly in the Forex space, but a lot of interest rate dynamics shifted markets around. A lot of stimulus. We thought that we were the only ones that did stimulus. China might do stimulus bigger and better than us. I was telling you that I've been long China for months, just waiting
for that big bazooka.
waiting for the money tree to get watered over there.
140 billion, they say.
Sure.
That's the stimulus.
Sure. It doesn't even sound like that much.
No, it's not. We were doing 100 billion a month. You know, we need to get back to that.
140 billion doesn't sound like that much.
Turn the printer back on.
He's gonna.
Let's juice these prices. Frank, we might be close to blast off mode. We've been talking about this for some time. I want to jump into it here in just a second on the show. We're going to talk about seasonality today. Before we do that, though, housekeeping items. This is what you do if you stream live on YouTube. You tell everybody to subscribe to the channel, hit the like button, or in our case, tickle the like button. But also, subscribe to the best crypto email you'll read all week.
Yeah, or month.
Possibly, if you're only reading it once a month.
Only willing to go a week. Okay.
This comes out every Saturday. I just wrote about gamma squeezes, a lot of what's going on in the market right now, post options approval, at least the first round of approvals out of the SEC. It's an action-packed, jam-packed, insightful, informative weekly crypto email.
Gamma squeezes.
Yeah, we were talking gamma squeezes this weekend.
In crypto options.
I believe there's the possibility on the IBIT ETF, but you're going to have to read the email to find out more about this, Frank.
I can almost guarantee there's no one else talking about gamma squeezes in the crypto space.
There are probably a few others.
Dude.
But we come at it from a different angle. Get the email, sign up, tastycrypto.com. I think the link here is in the chat if you're watching on YouTube. And one more thing for you, Frank. We don't talk about this too often on the show. We have what is quickly evolving into what I think is a really good app. Crypto app. It's a self-custody wallet. Gives you access to a variety of blockchain networks. Is more of a platform in terms of what we're evolving into.
What networks can I access?
Bitcoin, Ethereum, Polygon, Solana, and coming very soon, Coinbase Base Network, which is an Ethereum layer 2, as you know. So download the app. You can log into your Tasty Trade account if you have a Tasty Trade account. If you don't have a Tasty Trade account and you're watching this show, I don't know what you're doing. Go get a Tasty Trade account. But if you have a Tasty Trade account, you can log in. If you have crypto transfers enabled and crypto trading enabled first and foremost, you have crypto. You do need a little crypto here. You can easily transfer it through the app. So this is how I like to think about it, Frank.
Yep.
Tasty Trade, the brokerage.
Yep.
That's my crypto store.
Okay.
I go to the store. I buy some ETH, for example. I can take it home with me now. We've got transfers. You can withdraw your crypto to a wallet address that you control on-chain through the Tasty Crypto app. Now you've got your Tasty Crypto. You've got your crypto at home.
Okay.
You do what you want with it. Plug it into Uniswap, stake it, create a liquidity pool, swap it for other tokens. Whatever you want to do, you can take it home from the store, play with it at home, use the Tasty Crypto wallet. You can do all of that. This gives you access to everything on-chain, Web3, DeFi, you name it, all here in the app.
And you can't access those super innovative spaces that allow for alpha, yield in so many different ways than traditional finance markets without buying crypto from the store, right?
Correct. I mean, look, you don't have to buy it from our store.
Okay.
Tasty Trade store, I should say. But
you
$0
need
commission,
it.
35 basis point markup.
Okay.
It is, it's a pretty good value,
Good
I
deal.
think. Yeah, you got to get your crypto. You've got to get it to a wallet address that you control where you have the private key. That's what Tasty Crypto gives you access to. So if you don't have this, check it out. Mobile app, iOS, Android. There's a browser extension too, but the mobile app is jam-packed. That's the one that I
And you
would
might
get.
also say, why would I buy the crypto from the store? Why don't I can use my US dollar. My US dollars can do, all of those. First of all, your US dollars can't do
That's
those
right.
liquidity
It's
pools
fiat
and everything
trash,
else.
Frank. We know
and
that.
Also, your US dollars are worth less every year
Yeah.
in an inflationary environment.
With Jerome running that printer, they sure are.
And your Bitcoin historically has appreciated by 50 to 100%. on an average annual basis, which is not indicative of the future. But there's not only are you buying your crypto at the store and using your Tasty Crypto wallet to access products and places for yield and alpha in your portfolio that you simply can't without going to the crypto store first, but also you're diversified in that you're not holding these US dollars that if Powell is going to cut a handful of times and turn that, what do you call it, the money bazooka?
Well, China has the bazooka.
Okay,
we have
China has the bazooka.
The printer. The printer, in most cases, is much more powerful. It wins.
Printer beats bazooka.
You draw the printer card, and you are king. But a pretty big stimulus bazooka, not a bad weapon to have in your arsenal.
Your crypto isn't phased by bazookas or printers or any of these.
Fixed supply, my friend.
Gotcha.
That was a hell of a commercial for Tasty Trade Crypto and Tasty Crypto. Go check out the app. Frank, let's jump into it. You mentioned that Bitcoin's gone up. It has gone up 52% year to date. Other stuff's gone up too, right? Gold hit all-time highs, up 27%.
Pretty
SPX, not bad, flirting with all-time highs here. Some people think 6,000 is on the horizon.
Sure.
NASDAQ up about the same, but Bitcoin, it is volatile, obviously, and there have been points in time where it's been a lot lower, but here, year to date, has been one of the better performing assets. So just wanted to throw that out. Let's talk a little bit about recent performance. We were feeling, what's the word, giddy heading into the weekend, a little bit of profit taking, continue to trade within this range. We've talked about it. 50 to 70, and shout out to Adam real quick in the chat as they're popping up. I want to encourage more interaction in the chat here. Adam is asking, is Arbitrum on the roadmap? Absolutely. Base is about to launch, and then Arbitrum is next.
Hell yeah.
So should be a couple of weeks post base launch. But seeing a little bit of selling pressure here today, Frank. Anything behind it in your opinion before we jump in?
No, you're seeing most markets give back a little bit of last week's action. Yeah. I do feel sad because last week we hit 66, maybe got close to, maybe intraday hit 67 in Bitcoin in the futures, at least. We were looking at the futures, and I let out an O Bitcoin in the middle of in the office.
Yeah, like 66, mid 66.
And your brother was like, Did I just hear an O Bitcoin?
Did I get a price alert?
Yeah.
Yes,
and
you
did. That was pretty much the top. And now we've come off a couple $1,000.
Hey, if you start yelling on the desk, we'll take a little off the table.
When you hear Frank call O Bitcoin, then it's maybe time to take some profits.
One thing to call out here, Frank, is that momentum short term is in our favor. The wind is in our sails, at least for now.
Okay.
You've seen relative strength in Bitcoin and Solana. If you look at Solana versus Bitcoin too. Yeah. I think we've got a quote price of about 156, 155 or so right now. Actually outperforming Bitcoin year to date. Bitcoin year to date when I ran this was up 51% and Solana up 2%. Real quick, Clarence is asking thoughts on Pith. I own a little bit of it, but we'll provide a deeper dive.
You told me about Pith before.
Yeah.
So, I don't own any.
Just engaging with the chat here. Sorry.
What I love is I love we go through these, and Solana has been strong. ETH has been very sad.
Down 24% three-month basis. Sad.
The AI market is one.
I saw that.
It's
like
moving.
Half an hour ago. I was looking at that.
And two, I love that it's not uncorrelated. It's less correlated to Bitcoin, ETH, and Solana than a lot of this crypto space. If you're sitting there and your crypto portfolio is either all up or all down, and it's pretty much just a matter of degrees, take a look at BitTensor and Near protocol. Some of these AI crypto markets are not so correlated to Bitcoin and these other markets. And Tau over the weekend, getting back to 600. I mean, dude, I was buying some at 300 and 250, and I was like, this is painful. Because I think they broke 200 at some point, and I was just like, oh man, this is like going to be one of those stories of these coins that go down to zero, and I'm going to get annihilated here. But huge bounce back in BitTensor, Near Protocol, some of those, the AI crypto space.
Yeah, there are a lot of those stories where it's gone to zero. This one is, oh, it's not doing that. I've got it at 594, Frank, up from 240 just weeks ago. So a good trade if you were buying it there. We will do a deeper dive on a lot more of this, and I think we should come back to some of those themes that we've talked about, right? Because this is nothing new. If you've been watching the show, if you've been a dedicated community member of our Tasty Crypto community here, tuning in at, I mean, basically like dinner time, I guess, early dinner. If you're on the East Coast, you know, like if you're watching this show live, you're dedicated.
Yeah.
You're dedicated. We've talked a lot about a lot of different themes on the show, AI tokens being one of them over probably the last 6 months or so. I want to go back to that at some point and just look at the performance of some of these things and maybe just revisit where there might be some opportunity to see what's developed since we talked about them. But yeah, good point. You know, you are starting to see where, generally speaking, this is still all pretty positively correlated over, let's say, intermediate timeframes. But you are starting to see some pockets of strength here, even though you have weakness across ETH. You have weakness across Litecoin, for example, down 58% versus Bitcoin year to date. But Solana holding up, BitTensor, Tau, TAO is the symbol there that Frank just mentioned. So you are seeing, again, some areas of some relative strength that are interesting, and we'll jump into that a bit more.
Just a diversify. It's a market that is maturing. I guess I would say it's not so much, you know, if Bitcoin's up 5%, then everything is up 5% plus or minus, you know, 3 or 4%, and same to the downside. You're getting different action, just like in the stock market, where sometimes this sector's up, this sector's down, and the market itself is, you know, unchanged. It's just, it's nice to see. Obviously, it's nice to see as being long Tau for it to see the bullishness that's emerged here, but it's more a nice trend to see different parts of this market see some diversified action.
Absolutely. And I think, look, as capital continues to flow into the space, we've talked about that quite a bit post super rate cut, and certainly here on the heels of the Chinese stimulus bazooka, you're seeing pretty positive signs, I would argue, around inflows into ETFs. I think you see that continue to play out. We are 178 days, give or take, if my math is correct, Frank. It's not always correct. But if my math is correct, 178 days post Bitcoin halving in April. Historically, we've shown that the peak has been, does not at all mean that it's going to happen this time, but historically the peak in prices, if you do get that ripper that everyone is anticipating, and probably isn't going to happen because that's what everybody thinks is going to happen, so it's not going to happen, right? But if it does happen, it's around 500 some days. So I think as this plays out, let's keep an eye on it. And there's going to be more opportunities outside of Bitcoin. You know, we've got to see market cap dominance come down. It's still at 57%. But, you know, this could all change very quickly. That said, looking at the week ahead, volatility has been pretty sticky when we look at implied vols in the low 50s for Bitcoin and low 60s for ETH. It actually was 59% last week for ETH. Expected moves are about the same. 4,700, 4,800 for Bitcoin. There's your range. As we've traded higher, obviously that range has a higher high in it week to week. So, you know, we've seen some kind of bullish price action there. Ethereum really hasn't been able to break above and hold above 27, waiting for that to happen. I'm really waiting for that breakout above 70 too. I think it's probably easier to buy 70 or a breakout of 70 than it is getting chopped up right here. I mean, I'm still buying dips, but real dips, which we've shown are, you know, 10 to 20% on a weekly basis, not just a 5% pullback unless you're just trying to dollar cost average in. But it's a big range.
These ranges have held so strong in the last several months. And so, yeah, I would agree. I mean, until ETH, for example, breaks 2,400 or 27 to 2,800, I mean, you could trade both sides of it. You could trade options around it soon. You could trade liquidity pools around it. But yeah, I mean, every time it gets up to 2,700, Ryan, I'm almost like sitting there watching the price action tick for tick, waiting for it to jump, you know, 20, 30, 40 bucks above 2,700, and it just hasn't happened. And so these ranges, a very fair price for volatility in these crypto markets.
Speaking of ranges, Frank, and we're going to talk about seasonality here in just a moment. I'm looking at the price chart of Bitcoin that I have, the one that we show from TradingView in the Tasty Crypto email every week.
Okay.
Massive range. What's interesting about this is it has puked into the start of the month the past few months. So the low was pretty much going back to July. On the 4th of July, 5th of July, down there at about 51, 52,000. Rips all the way back up to 70, pukes on August 5th, and that's a technical term, pukes. That's when it goes from the very top of the range and just
It's not good.
all the way down to the bottom. People are freaking out. We're doing specials.
Yeah, you're right. It's the first
going on
first week of every month.
Sunday night. Yeah. And again, we saw that, not to the same extent, but pushed to the monthly low on, it looks like Saturday, September 7th, right? And so that recent high was about 65 down to 52. If you bought 52, 53, somewhere around there, you were able to ride that back up about another 10 grand. Rolling over as we start what some are calling Uptober. Frank, are you worried that 50's back in the cards to start the month?
I'm not worried because this market has, like we just talked about, it's traded both sides of this range. It's traded 50 a handful of times, not 50 even, but it's traded in the 50 handle a handful of times, and it hasn't really broken down below that. And so, of course, anything is possible. And yeah, to your point, you look at the first week of August, you look at the first week of Sep, and you look at the start here of October, and it's bearish.
Yeah, it's been a pretty clear pattern. It's interesting. We just live in a matrix, I suppose.
But yeah, I mean, going into Uptober, I mean, up is in the name, so why would I be afraid? I don't get it.
All right, let's talk about it. So today's show, the main topic, the only topic, Bitcoin seasonal performance in focus as we get out of September, which is previously or historically has been a pretty poor performing month, and into October, which kicks off Q4, which by far and away has been the best quarter for Bitcoin.
I was hoping
when we
you
look
were gonna
back.
say that.
So I want to talk about this. Argue with me a little bit, Frank.
No.
Okay. Well, let's jump
Only
into
agreeing
it.
with you.
What is seasonality? To start off, what we're talking about here, what we're referring to is, I don't know if you want to, it's not a phenomenon. It's just an observation. It is rooted in literally just historical price action. It does not mean whatsoever that what's happened in the past obviously is going to happen in the future. But as human beings, we like to just recognize patterns. We're very simple.
Yeah.
Simple beings. And so as a simple man myself, Frank, I've been looking at what has happened in the past with Bitcoin prices and hope that maybe if something good happened, it will happen again soon. So seasonality, the tendency for assets to exhibit recurring patterns of performance during specific times of the year. The fourth quarter has historically been a strong period for Bitcoin performance. Why do we see seasonal patterns? Well, it is rooted in fundamental behavior, I suppose. It could be rebalancing. It could be just how different participants in the market approach the market, how they behave at times. It has to do with liquidity dynamics, right? We've seen central bank activity. Sometimes these things are somewhat cyclical in nature and happen around the same time of year. And also sentiment, right? I mean, I think one clear, real clear example of seasonality in some ways is you just look at participation over the summer months, right? Versus other points in time. There's less liquidity in the market. There's less participation. There's less activity. Everybody's on vacation. Everyone's at the beach. It doesn't mean that crazy things can't happen in the market, but generally speaking, there's just less activity.
Sure.
Right? It doesn't necessarily mean prices are going to go up or down, but we do observe that.
Yeah. And I mean,
that's a
there's-
real thing.
There is absolutely confirmed seasonality in a lot of commodity markets.
Yeah.
Like
yeah.
agriculture markets and energy markets like natural gas. There's seasonality. We're entering right now the seasonally volatile time of year for natural gas. Now, what's interesting is the way that we like to talk about seasonality on this network is that you can draw a trend, a correlation between time of year and volatility in an asset. And to your point, summer months and equities it's really hard to make a case for equities being seasonal. But what you can absolutely point to is over the last 10 years, 20 years, as much data as you want to put into a model will absolutely tell you that equities are less volatile, have been less volatile in the summer than they are in the fall and winter. And it might have to do with the fact that a lot of the world, especially Europe, high volume institutions have a lot of vacation time in the summer, lower volume, lower amounts of big institutional funds flowing in and out of markets. But we don't usually assign direction to it. And so I want to see, because you say historically it's been a strong period, a bullish period here at Q4. So I want to see if there's a directional component to this piece.
We got 4 minutes. We got 4 slides. Let's do it.
Rip it.
It might not be time to heat your homes just yet, and it might not influence natural gas prices.
Okay.
But crypto tends to go up starting in October. So I ran the numbers for you here, Frank.
Look at November.
And
Big middle finger there for you.
A big one. We're going back to 2016. And I think you have to also take into consideration that when you look at this in percentage terms, we have had at times much, much lower nominal values of Bitcoin.
Sure.
Where, right, something can go from 10 to 20.
Started at 0.
Exactly.
It's at 60K.
The percentage, the magnitude here can be quite large as a result. So that can skew this to some extent, I suppose. But we're just looking at average monthly returns going back to 2016, okay? You really don't have that many bad months on average. You have underperforming months. But September has been historically where you have seen negative returns.
Only average negative return.
Yes.
Wow.
Okay. November, as you mentioned, huge return on average, close to 35%, October, December. But this kicks off this idea of October, of Q4 being the best performing month, okay? So if we look at average returns on a quarterly basis, going back to 2016, here are the numbers. On average, Q1, 25%, Q2, 16%, Q3, that's when September occurs.
Heard about that.
9%. Q4, October, let's go, 55%, okay? So does not at all mean that this is going to happen going forward, but historically has been the best performing quarter by far, double the performance of Q1 historically.
What's interesting, for 1 second, I know we only have a couple minutes left, and I know you have some more data that you want to throw at the folks here, but what's interesting about this is, in my mind, not even necessarily the time of year. I don't think that this market has like a memory for what time of year it is, and so like it has to go up. Every November, it has to go up. But what this does confirm, similar to almost any market, that if you take risk, you can profit. A risk on market, so to speak, is that when it performs poorly, historically, after it performs poorly, it tends to perform well. You and I talk about it all the time. If you see a huge down move in the S&P or any risk on market, it has tended to move higher the next day or the next week, whatever time frame. And so I'm not surprised at all to see worst quarter, historically Q3, best quarter Q4.
Well, here's the thing, Frank. I asked a slightly different question.
Okay.
I asked the data. What happens when you have the best September since 2013, which, well, yes, September typically has been a down month. We had one hell of a September, 50,000 to 63.6 right now.
Pretty good.
So it's happened 5 times. And when it happens, Frank,
I can't even do it, dude.
When it happens, your Q4 on average goes from mediocre 55% to 145% when you have a big September. So just keep that in mind. Again, this is not a prediction, a recommendation, or anything. It's not even a forecast. It's just simply an observation of what's happened in the past. Okay? We just had the best September since 2013.
Okay.
And when you have a positive September, which has happened 5 times, it goes up a lot more in Q4. All right? That's at least what it's done. It doesn't mean that's what it's going to do. That's what it's done.
Bitcoin has 145% Q4 this
Blast
year.
off mode.
I'll kiss you on the show.
All right. We'll see what happens, I suppose.
145%. Unbelievable.
We have seen some crazy stuff, but think about it. right? We've come out and said we think that it could go up to 100, 150. Some people are calling, I saw today, headlines around 200,000. There's analysis that's gone into this. There's a fixed supply. It does depend on some stimulus and money printing. But yeah, I mean, look, if you think it can go to 120, if you think it can go to 150, I'm not saying that's going to happen in 3 months, but and take into consideration again that we were at much lower prices, right? So some of this is probably skewed by the fact that it went from 10,000 to 15,000 or 10,000 to 20,000, whatever it might be. But it's possible. One last thing I wanted to look at was seasonal volatility. Of course, as we know, there's a bit of a positive correlation that we observe between volatility, the magnitude of the returns here, and the price direction. And so we've seen Bitcoin at times
This is actually pretty interesting.
is more volatile when it goes up, and no
Yeah.
surprise, given the size of those moves. This is your average quarterly volatility. Q4 is 114%.
With September being the worst month historically,
Yeah.
which doesn't necessarily again mean anything. Oh, every September.
But this is just the quarter. But yeah, playing into that.
But September being in that Q3 and Q3 having the lowest volatility of returns does tell you how volatile this market can be to the upside.
Yeah,
And it's what we've seen, right? And look at the last year of price action alone. The market has doubled, tripled to the upside, and all of the pullbacks have only been 20, 30, 40%. And so yeah, you have the upside skew for sure.
All right. Well, that's going to do it for our show. That's a look at, again, just objectively speaking, what's happened in the past as it pertains to seasonality. Fingers crossed that we get anything like this here in October for Q4. But having some fun with the data today. Wanted to take a look at this as we enter into what some are calling Uptober. But that's going to do it for our show. Victor Jones is up next with The Price of Truth. Frank will be back with me next Monday. I'll be back on Wednesday. Until then, this is the Tasty Crypto Show, and I'm Ryan.
Frank.
Peace.
It is Monday, September 30th, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast called The Price of Truth, where we like to explore the incentives that govern our world. It's normally simple. We have great minds come on and share great ideas, but we are riding shotgun, and we are solo today, which means it's a participatory show, and it's the first show where we're actually going to have extended hours going forward. So if you remember, I think we started off at like 30 or 45 minutes. We upped it to 60. Now we're upping it to 90. So we're going to go 90 minutes straight. I don't know if you guys are ready for it, but I sure as hell am. I'm excited to see all of you. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't have both of them, make sure you go get them. But if you want to be part of the conversation, there is only one place to do it, and that is on the evil Google YouTube. So hop on over to YouTube, type in Tasty Live, go to the live segment, go to the live tab, find my face on a thumbnail, my big inflamed head on a thumbnail somewhere, jump in and start typing in random ass characters. Why do we type in random ass characters? We want to spoof the Google algorithm. The more active you are in the chat, the more they're going to put this video in front of people. And the whole idea is to save the world one view at a time. Speaking of the people, this is a show by, of, and for the people. We should say what's up to the people. What's going on? YouTube chat. Brian Thornton, I see you. Cato Prime, what's up? Absolute Beginner Loan, great to see you back here. VW. VW. Who says W that way? You can tell part of the country I was born in. Cactus Leo. Jay Wright, what's going on? My living room music. What do you guys listen to? I'm kind of curious what kind of music you guys are into. I'm starting to get to that age where, every sort of generation goes through that like 30-year-old phase where you listen to new stuff and you go, I don't get it. What are you guys talking about? I throw in my old tapes. What's up? Why not? Jazz, Kimberly Thomas, great to see you. Rezo, Sterling. I would love to just sit here and shout out everybody's names, but they tell me I'm not allowed to do that. So unfortunately, I'm going to have to actually say something of a little bit of substance here. But I just want you to know I would like to just shout out all of your names. However, you'll notice all your names are streaming on screen. So say what's up to the people if you want to. Be respectful so we can keep the stream up, but have some fun at the same time. We got a lot to talk about. We're going to set up the week that was, a little bit on last week. Talk about what to expect this week. Some decent earnings around the corner, a handful of them that are worth, I think, discussing. Excuse me, the economic calendar. The Fed squawking has not stopped. You're going to hear a bunch of Fed squawking again this week. A little bit about the hurricane impacts so far. A little bit about the port strike that seems to be on its way here. And a handful of other things. Some nuclear. I want to talk China a little bit. These Chinese stocks, what to do at these sort of price levels. So we got a lot to talk about, and we're gonna have a lot of fun. So do me a favor, hit the like button, and let's get this place rocking. What did you guys say? I played my guitar for an hour today. That's what I'm talking about. Play some real music. Let's get back to that. You know what I mean? So we got a lot to talk about. Let's get going. Powell zigged and the market zagged. Yeah, they just can't help themselves, can they? But it ended up just being short-term opportunity. Let's get going here. Let's talk a little bit about what to expect this week. No. Let's set up last week. So coming into the week, we had the Nasdaq up a little over 1%, 1.1% to be specific. In the NDX, the S&P last week up about 2/3%. All S&P sitting at and making new all-time highs. The Nasdaq not necessarily close to that sort of 21,250 level. The Dow Jones was up around 2/3%, and the Russell was up about 0.5% as well. So a bit of I would say, a bit of a digestion week last week, and you definitely got the yield curve last week. We moved through around 26 basis points. We had steepened up to 26 basis points. That was the maximum pressure that the long end of that curve we basically lifted, or the highest rates were about Wednesday is when we expanded all the way to 26 basis points. Thursday, you got basically a reversal in the yield curve, meaning the long end rates started to ease last Thursday. And in my personal opinion, that helped ease and helped fuel the NASDAQ rally that we saw on Thursday. Just taking a quick look at the yield curve, everybody, so you can sort of see what this looks like. Typically, we're just focused on the 210s, but you can see those shorter term maturities are still paying, 5%, or between 4 and 5%, all the way up to Fed funds futures at 5%. And we've been watching what we believe, or what I believe is likely to happen. And we saw the first part of this when you start easing the front end, or the Fed funds futures, Fed funds rate. The market's going to have an expectation that that's potentially inflationary, and it seems the Fed is trying to execute that at the exact same time where global growth data is easing. Why? Because if global growth is easing, there tends to be an increased demand for bonds. Well, I don't say this is why, this is my interpretation. So in an environment with increased demand for bonds, you start to lower your Fed funds rate, which is then going to increase the yield on the longer term securities, because people are sort of nervous. Hey, this is going to cause a reacceleration of inflation. But on the other hand, you've got the demand for bonds that are increasing, because you've got sort of this global slowdown, and perhaps that will keep a lid on the upward pressure, or the upward direction of the long end yield curve. And I think we're gonna watch as effectively they continue to take down short rates, and that long end rates continue to tick higher, and we just continue, I think, to see steepening if the best case scenario plays out, right? If you don't run into some sort of credit issue, if you don't run in, you don't have this massive geopolitical escalation that might play itself out. In the best case, ceteris paribus, I think you continue to ease the short end and the long end just continues to rise. And that's how we get out of this thing and we end up in a steeper yield curve that's more accurately priced for U.S. credit risk. You know, but sometimes the best intentions aren't exactly where you end up, right? You might have great plans for where you're trying to take this thing, but there's a lot of risk along that journey. So we continue to watch the long end of the curve. Last week, as we got closer to 125 in the bonds, we got down to like 124 and change. You can see it here. I closed out a lot of the short deltas in ZN and ZB. I just think this is going to be a little bit of a congestion area at 124. It was previous resistance. The likelihood that it becomes some sort of short-term support, I think, is high in the short term. And so I kind of want to give the market a little bit of time to digest and pick a direction here. Who knows? We might just trade sideways. So I didn't think the risk to reward favored having a directional opinion anyway in the long end of the curve here, ZN and ZB. But that's sort of the lay of the land for how we come into this week off of last week, why I think the yield curve was fundamental into, the shifting yield curve played into risk assets, in particular on Thursday when you saw the reverse basically flattening. So we had steepened up to 27 basis points. We ended the week at 20 basis points. And that's the difference between 2-year yields and the 10-year yields, which is now positive as we've moved out of inversion. And that we had steepened up to 27, 26-ish, and we came back into 20 at the back end of that back end of the week. Lowered yields. All else equal is bullish for long duration securities. So technology, lots of high beta instruments, and I think in some ways that's sort of fueling that increased risk appetite. Part of it. Let's see here. ZB gravity for a place to add to an existing position to start a new one. Yeah, so I'm flat in the long end, and we'll look for opportunities here. Hopefully, I'd love to see them rally them back up to 126-ish and be able to start adding new short delta positions. I just don't love the risk and reward here at 124. Beyond the majors, the big stories for last week are, sort of we're seeing the reversal of that today, which shouldn't really surprise a ton of people. You got to imagine, right? Like last week was a gigantic week for materials. It was the outperforming sector. It was up 3.5%. The next closest sector was consumer discretionary, which was up 2.3%. So it had a massive outperformance relative to the market and relative to the closest sector. Why? Your material sectors, they're going to track things like, Freeport-McMoRan and Newmont Mining, a lot of those instruments, which did really well last week. So as a whole, materials were on fire, and they eased a bit today, down, 73 cents on a $96 stock or so. So we eased by maybe just under 1%. Which, I don't think that should surprise people. You get these moves, I don't want to call it parabolic, but materials don't tend to move with that level of sort of, 3.5%, and the overall market was only up 0.2%. That's massive outperformance, and it shouldn't surprise people that you see some rotation out of those names to get portfolios into better balance. And I think that's basically what we're seeing here today. Couple that with the fact that gold was fairly weak, backed off highs for the last couple of sessions, and I think you've got your story for why you're seeing a little bit of weakness in materials. I don't know that it's enough weakness to try to take on new positions. I've collared a lot of my materials, so a lot of those not collared. Yeah, I've collared a lot of the material stocks. So Newmont Mining, Barrick, GDX, GDXJ, which are the gold miners and the junior miners. I've collared a lot of that stuff. And so my general position, I know some of you guys are volatility sellers. I like to play that game sometimes, but I also like to add just net longs to a portfolio when stuff gets cheap. And I know cheap is relative, but for me, so I've had these miners for a while, ever since Druckenmiller reported a big position on Newmont Mining earlier in the year. I started building a position on a lot of these miners, and they've done well. And rather than starting to sell this stuff, because if you look on a short-term time frame, and this is going to be the same thing as your Chinese stocks, same type of story. If you lock yourself into one time frame, you could look at this 1-year daily chart and you could say we're at price extremes, right? Very easy to say that. But if you look at these instruments over a longer period of time, I always do this, and it ruins the point I'm trying to make. So Newmont Mining is a good example. Over a 1-year time frame, you look at this and you say, all right, we're at price extremes. But over 5 years, it's a very different story. You're only mid-range relative to the highs. And Chinese stocks are going to be the exact same, right? If I look at something like probably Alibaba, we look at a 1-day time frame, it looks ridiculous, or 1-year time frame, it looks ridiculously expensive, right? But if we look at a longer term time frame, you can see on a longer term time frame, this doesn't give you the same story. My point is, so on some of the things that I don't think are at absolute price extremes, they're at short term price extremes. I like to collar that stuff. And then if we end up getting a break in price, what I do is just basically take off the hedges, so sell the long puts, buy in the short calls, and then add to the position at lower prices. So that's the way I try to navigate the world. More often than not, it doesn't work the way that I had hoped. More often than not, what happens when I put on a collar is the stock shoots above my short call strike, and I'm buying in calls and rolling them out. That tends to be how this playbook works. But every once in a while, the stock goes down while you have a collar on, and you end up feeling smart, like you're who's the famous guy who put on the collar on his stock before the 2001 crash? Mark Cuban. That's why Mark Cuban's like considered. That's what he's famous for. He just put on a collar, and he kept a lot of his equity through the .com bubble bursting. Anyways, so that's the material story. The second best performing sector last week was discretionary, and I'm sort of scratching my head about that. And especially with the potential of a port strike here, as we get into that, and I know the impact of the port strike is really going to be time dependent, right? If they work it out in a couple of days, we're not going to see that much of an impact. But it's sort of like exponential. Each week this goes on, the more impact we could end up seeing from this port strike. And I had this conversation before we went on air with Tom yesterday at First Call. And if you don't watch it, basically every Sunday evening at 5:00 p.m. The futures open, and Tasty does a futures open show on Sunday night. If you weren't aware, it's called First Call. And before we went on air, I had a conversation with Tom, and I said, what do you think the impacts are of the port strike? And he goes, it's priced. That's what an efficient market theorist should say. And I go, I know it should be priced, right? But I looked at everything I could think of. Like I looked at the shippers, like SBLK and a handful of others. Maersk is not. I think it trades over the counter in the U.S. market. So I did as best as I could. I look at Walmart. I look at Costco because they're highly port dependent. I look at the shippers. I don't really see anything going on there. I'm like, I know this should be priced somewhere. It's got to be discounted in some way. And I look at the individual implied volatilities, and I see higher implied volatility for this week than next week. You tend to only see that when something has earnings or when it has an event that is driving up demand in the short term. Normally, vol is synthetic time. So the more time you have, the more time you have something to go for something to go wrong. The broader or the wider the distribution curve, so the higher the implied volatility. So if you put this week aside, and then you should see what is normal is we go up in vol as we go out in time. That's not necessarily the case in the front month for some of these instruments. And so I'm like, all right, well, maybe that's where the potential of these port strikes is basically showing up. But I did notice today when I started to really think about it, I would be, the second thought that I have is maybe I shouldn't be looking at the top tiers, like the Walmarts and the Amazons of the world. Maybe I should be looking at like the lower end retails. And I saw today, again, this is multi-factor, right? This could be many different reasons, but I did notice Dollar Tree got absolutely smoked today. So I wonder if some of that has to do with pricing in the potential of this risk. Let me ask the chat real quick. What do you guys think about the potential impacts, whether it's risk or opportunities for the port strike? Do you have trading ideas around the impact of this? I normally don't like to think this way because these things are generally priced, and I'd rather be talking about events that are 6 to 9 months off and thinking about how to price those things. I think there's more opportunity in that type of stuff. But something about this bugs me. It feels like we're very complacent around the potential of this, and it seems much bigger to me than the market reaction and response. Tell me if I'm crazy. Do you guys have, where do you see it priced? Do you see it priced, and where do you see risk and opportunities in underlying instruments? I'll come back and I'll read your responses in just a little bit. But one of the other things I noticed about last week as we get into this week, and we'll start to set up what to expect for this week, but I had a couple of themes I wanted to cover. And now that we've got 90 minutes, I don't have to rush through these things. I can take a little bit of time to expand. I also noticed that not only was Tesla, it's had this nice little run, but you also saw a resurgence in solar instruments and a resurgence in basically the whole clean energy theme. So Tesla was higher last week, but TAN, which is, if you can remember, everybody was trading this stupid ETF back in 2020, right? When everybody was going crazy and COVID money was all over, liquidity was just all over the place. I remember every millennial was talking about trading TAN and PBW, right? And both of those things had a pretty decent week last week. TAN was up like 5.75%, and PBW, which is basically a clean energy ETF. All these themed ETFs have everyone threw them in the trash since 2020, but this themed ETF was up 5.5%. And, so some part of me wonders, is that real? Have we just thrown out the baby with the bathwater on some of these themes? Or is this a bit of, short covering? Because you can't tell me that if you look at these Chinese stocks, like this doesn't happen just because people change their minds that quickly on the valuation of securities. Like, I get it. The PBOC sort of did an about face with monetary, but I think for the most part, the market saw that coming. That was a known. It was just at what point, and then how big would the monetary stimulus be? And same thing with the fiscal package, right? The $284 billion in sovereign bonds, something like this. That's not huge, but it seemed like it was enough to cause a massive short covering rally. And so there's a part of me that is looking at some of these, this TAN and PBW, some of this stuff. Are people getting excited about these themes again, or are we seeing a bit of short covering now that there's rising liquidity and more, liquidity type events that are happening in the marketplace? Do you want to get caught short in that environment where we're now in an easing cycle with added liquidity from central banks, both domestically? We're not adding, I shouldn't say that. We're adding fiscal liquidity. That's probably a rough place to get caught short. And I think anyone that was short Chinese stocks, they're learning that message. They took a lot of pain. And I wonder if some of these rallies are not more short related than they are people getting excited about the clean energy theme. But it was across the board. All the stuff that you and I, all the stuff that we've been talking about. Albemarle had a great week, back up to near $100. And this is one of the largest lithium providers, and we're in a lithium glut, priced out for the next couple of years. And everybody tells me that, right? Don't put your money in Albemarle because there's a lithium glut, meaning there's oversupply. But to me, I go, isn't that when you want to start accumulating a position? Because if I'm accumulating a position when we're short lithium, well, Albemarle's going to be in the clouds then, because the market's going to see that coming. So this is what we've been doing on this show. When nobody was talking about nuclear, we were adding adding some positions in nuclear. When everyone threw out the whole electric vehicle investing theme, we started accumulating Tesla. We started accumulating a little bit of Albemarle. I'm probably mispronouncing that too, by the way. I remember the first time I said, I think my first day as a licensed representative, I was just giving quotes on the phone. Somebody called in, they said SLB. And so my first quote as a licensed representative, the guy asked for a quote on SLB, which is Schlumberger. And I mispronounced it as Slumberger. And nearly 20 years later, I still haven't forgotten that mistake. You ever make a mistake and then you think about it sometimes in the shower and you're just like, oh, why did I do that? That's one of those. Anyways, let's keep cruising here. We talked about 210. A couple of other pops. So Wynn Resorts had a massive week last week, up 22%. Same thing with Las Vegas Sands. And this is the type of stuff that scares the hell out of me, It scares the hell out of me that these instruments can move that much. Nvidia on earnings, adding hundreds of billions of dollars in market cap. Meta, Las Vegas Sands, Wynn. I mean, these stocks are just hockey sticking. And some of that might be a feature of maybe a bear market rally or just massive short covering. But I'm starting to see this stuff all over the place on all of these charts, just straight up hockey sticking. Am I the only one who gets nervous when I see stuff like that? Same thing with Micron, but at least you had a catalyst here. With Wynn and Las Vegas Sands, that looked like it was related to basically the China story. They've got a lot of Asian exposure. So it's in David Tepper on CNBC had mentioned that those were some of his China-related plays. He was very bullish, saying he was making big bets in China. And he called out Wynn and Las Vegas Sands explicitly, and those things went gangbusters. At least Micron had earnings, right? Micron had earnings up 18%, so at least there was a catalyst here outside of some guy talking about a stock on CNBC. But Albemarle was up 12%, as I mentioned, and a few drops from last week. None of them I picked up. I want to ask you guys if you picked up any of these. So the drops from last week, Jay Wright saying, I get nervous too. Absolute beginner, hyperinflation charts. That's what I'm saying. That's exactly what I'm saying. To me, I go, is that a company becoming more productive? I don't think so. I don't think that's what it is. Is that a bunch of people all of a sudden for the last quarter going gambling, or a bunch of people changed expectations about how many people will be gambling in the next 6 to 9 months? I don't think so either. To me, this stuff is telling you, I don't think this has anything to do with, this has nothing to do with growth or changes in future expectations of growth or revenue. To me, this has everything to do with liquidity. And same thing with this. This is changes in liquidity expectations. But that's not the story, right? That's not what everyone else is saying. They're, I don't know. I got to take off this tinfoil hat one of these days and just start participating again. But I can't do it because I know the truth. SMCI was down. SMCI was down 8% last week. And every once in a while, we like to get crazy on this show. Like when Intel was in the dirt, it's a horrible company being kept alive by basically just free government money and taxpayer dollars. But at some point, it got cheap enough for us to take a shot and sell some out of the money puts. We got paid on it. So then the question is, even though this company is cooking their books in a giant scam, is it cheap enough, or is there enough implied vol for us to get interested? The answer is no, not enough implied vol relative to itself. It's only an IV rank of like 40, as you just saw, but it does have individual implied volatility of 90%. I always think that's sort of interesting, right? Because it means you can basically you're going to trade at zero. 100% implied vol means within a year's time, the market says this could either be zero or double. And those types of risk to reward bets are interesting. But I don't think this has. I don't love. Those 290s are kind of interesting, huh? A 10 delta for $8. You got to take on a bunch. It's because it's an expensive stock though. So you'd have to do a vertical with this. And the markets aren't too wide, but they're not great. Anyways, the point is that the only really big drop from last week, there was SMCI. This is the biggest one. Marathon Oil, I thought, is a higher beta energy name. So when energy companies start moving, this thing tends to outperform just because it has a higher beta. So if a rising tide lifts all boats, all else equal, assuming the market wants beta, because sometimes they want value over beta or value over growth. But all else equal, when energy starts moving to the upside, this will outperform. Well, energy didn't move to the upside. Like that was last week, or excuse me, that was 2 weeks ago. Last week, you actually had energy doing the exact opposite. It was down. XLE was down 1%. So then your higher leverage or higher beta instruments are going to underperform. And I think that's part of the story here for MRO. It underperformed last week when energy sort of took a breather because 2 weeks ago it was on fire. Here's 2 weeks ago. You can see what Marathon did, 26 up to 28. And it just reversed it last week. All right, there's my pops and drops. Let's get going to the earnings calendar. We talked about the yield curve. Let's see what you guys are squawking about. Who gives? You play the stock data regardless of PE, or if you think it's a crappy company. I know that you guys are probably having a conversation in the chat here. If I could offer my thoughts, I don't make individual buy and sell decisions on PE. But like I won't short something because something has a high PE. I'm more likely to be interested in buying something that has a low PE on a relative basis. But I won't short just because something has an extended PE. There's got to be other factors. So this week's earnings, I'll go over them really quickly. Carnival Cruises was this morning. The winner was the short vol trade because it basically traded a little bit down, but not by much. CCL, yeah, they're down 13 cents. So it had a long tail, but really the short vol trade was the winner, not bulls, not bears. And I think tomorrow, after the close, is probably the biggest and most interesting of all the earnings events this week. So it's Nike. Nike is in the middle of a CEO transition, which is why I think this one becomes a little bit of an interesting game theory. The game theory is historically, this is an opportunity. Like Boeing did this exact same thing. When they fired their CEO, they completely couched their first earnings report. And just like from a game theory point of view, a new CEO can get the market expectations on the floor it's easy to jump over an envelope. So game theory says that a lot of the times you tend to see a sort of a couched earnings report on CEO transitions. I have no data to support that. That's just my anecdotal evidence and what I've seen over time. But I could be proven wrong with actual data. So the game theory here is, as you go into Nike, the new CEO takes over, I believe, on October 14th. And so, is this an opportunity to do some crazy write-downs or lower street expectations ahead of that CEO transition? I asked that question to Tom in yesterday's first call, and he said no. And the reason he said no made a lot of sense to me. He said, if you look at what the market has done since the new CEO announcement, so you've gone from $75 stock basically up to $90. He's like, the market's already telling you it has raised expectations. So it's going to be really hard to get those expectations back down. And why would you want to do that? You would want to go with the momentum that the market has given you. And I think that makes a lot of sense. Regardless, I don't think that should impact the way anyone trades. I just think it's sort of an interesting aside as we go into tomorrow's earnings event. Implied vol is relatively high, 70 IV rank. So I think this one's interesting. I think I want to play this one to the upside. I think I want to play it to the upside, even though it's weird though. Because what could they say about the future, right? We're in an uncertain environment. So it's really hard. I think it's really hard for any consumer discretionary company to get bulled up on the future. But if I had to do anything, I think I would play this slightly directionally biased to the upside and be risk defined. I don't think I want to get caught short naked risk on either side, especially with all the hockey sticks in the marketplace. I don't want to get caught naked short anything. Forget about the news. Nike T equals 158. You think so, Kimberly? 158. That is aggressive. I would play this slightly to the upside. We shall see what happens. What do you guys think? Are you selling vol? If you're selling, what strikes are you selecting? If you are directionally biased, tell me which direction are you biased going into this earnings event on Tuesday. I will play it really small, and what I would really hope for is, for whatever reason, if Nike gets a bit cheaper, if it gets sub 80, which I think is unlikely because the expected move I think was like $8, $5, 580. So I think it's unlikely it gets below 80. But if it gets in that range, I'd probably start adding something. The move is DKS. Interesting. The other one is Foot Locker. Yeah. To me, I just think we're in a period where the mid cap names, and theoretically, if we're right about where we are in the cycle, the mid cap names start doing really well in this part of the cycle. Mid to small cap names. Without it to small cap, you got to be careful because you don't want small cap names that have high leverage or high amounts of debt. But this part of the cycle, you got to watch those mid cap and small cap names with decent balance sheets. This is the part where they could hockey stick for the right reasons. Absolute beginner. Venezuela stocks are the best. Oh, that's good. All right, so that's our earnings calendar. There's a few others, McCormick ConAgra, which is a Staples company, on Wednesday, and then Constellation Brands, which I think actually has a pretty decent implied move. So STZ. ConAgra, it's not worth talking about. It'll be a headline because it's a big company, but those Staples companies are the most boring to trade binary events. They have 2 to 3% implied moves. It's just not worth the risk ever. So it's not worth talking about. Constellation Brands, though, yeah, $8. Yeah, even that's pretty weak. That's like 3 or 4% too. So nothing there. Let's talk about earnings the economic calendar, the setup for the week. up? Yes. Okay, we got the right one up. So we had Chicago PMIs this morning. It was a little bit stronger than expected, and Powell's speech. So I think the takeaway from Powell's speech, if you didn't watch it, the biggest part, and I can show you exactly when he said it. Let's go to our 30-year. Let's go to the bonds. We'll go to 5 minutes. Here we go. And this is when he was talking, and this is when he said something important right here. And you can probably see that in all of the maturities. I bet if I go to 2-year, it'll be even more pronounced. But basically, there it is. Boom. You can tell exactly when he was speaking and when he said something important. We basically told the market to not expect 50 basis point moves, to expect 25 basis point moves going forward. And I think that dampened current expectations that that they are going to aggressively cut and continue to move at 50 basis point clips. I don't know. I think that's just, I think this is all gamesmanship, right? They're snake charmers, and they want to charm the 2-year a little bit higher, right? Because the lower that thing goes, the more that the market is going to pressure them to continue to cut at an aggressive pace. So I think they say what they can to try to get the market to respect their desired path. But if the 2-year doesn't play ball, if it goes lower than 3.5, then the market's going to pressure the Fed to move. And if they don't move with the market, so the market's telling them this, but the Fed does something else, that difference in expectation is when you get market volatility. Right? If you go back and you just think about it, when we started the cutting cycle, when we started raising rates, remember the market was like, maybe they'll raise rates 3 times. Like honestly, they thought they would raise rates, and me too, 3 or 4 times in a year, which was basically we'd be at 75 to 1% in the Fed funds rate, and they jacked them on everybody up to 5. And what do you get? The natural result is vol. When we came into this year, what did the market say? The market says you're going to cut 6 or 7 times. Fed says, no, we're not. And so you didn't necessarily see downside vol. You saw upside vol. No, you saw downside vol. So when they priced 6 cuts, market starts running in October, November. April, they start to ease off March and April, they start to ease the market off those expectations. You see downside vol. So when the Fed doesn't want to do what the market is pricing, those are environments where you can potentially see volatility because the market has to true up what they've priced to what the direction the Fed's going to go. And if you don't want to have an aggressive cutting cycle, well, you've got to talk the 2-year up, at least to keep it stable. And I think that's a bit of what we saw today. And I think we should continue to expect that. But the question becomes whether or not the 2-year whether the short end continues to listen. If that thing continues to plummet, then you know what the Fed's going to do. And if they don't do it, you can expect a lot of volatility if they fight the market. At least that's the way I see things. So tomorrow, it's a pretty big day for it's a pretty big day or week. Good Lord. It's a pretty big week for economic data. Tomorrow we have the ISM manufacturing index. We have construction spending. But more importantly, in my personal opinion, we've got jolts, Fed squawkers all over the place. These are just big landmines. I'm trying to skip them. Motor vehicle sales on Wednesday. So all of your, Tesla, GM, and Ford, if anybody's trading those anymore, Toyota, Honda, Ferrari, or not Ferrari. What's the... Gosh, I forget, but it doesn't matter. All of those names, even the Chinese EV names, I think those are all going to be in play on Wednesday based on what these numbers are. So be ready for that, either for risk if you have existing positions or opportunities. And we get ADP on Wednesday, EIA petroleum status report, which was a draw last week. And again, Thursday, claims, which can always create a little bit of volatility. Stellantis, thank you. And Ferrari, that is the one I was looking at. Race, yes, thank you very much. An interesting name, but not a ton of liquidity in Ferrari, unfortunately. ISM services on Thursday, and again, a bunch of tape bombers that could say and do anything in the afternoon. Me personally, I don't think you have to listen to these people because they will just say anything, but you do have to be ready for any of these people to say something meaningful, which could impact the curve, right? That's exactly what we saw today. Jerome Powell kind of tape bombed on the curve, which then created downside in the equity market, because if you have higher interest rates, you have to factor that in to discounted net present value of future cash flows. So the market did that whole dance, but they bought them up anyway. Any discount, they're just buying this stuff up because we live in Venezuela. And then Friday, the non-farm payrolls report. And I think the consensus, let's look at it, but I think the consensus is 144,000 jobs, 4.2% unemployment. Oh, this one's different. So I had seen coming into the week a different source with 144,000. This one's got consensus at 132,500. So you can see now that they've, now that we trued up and we acknowledge that we had overstated half of the jobs over the last year by 818,000. It seems these numbers are a lot more reasonable all of a sudden, right? That birth-death model doesn't work when you're at inflection points in the economy, and perhaps that wide difference between what the actual payrolls were and what we reported them at is a flashing red sign that we passed that inflection point. I know we all know this, like we're headed for slower growth, but it's just confirmation that that birth-death model is horrific at the inflection points, that both the start and the rollover of an economy, and overstating by 800,000 jobs is the emphatic stamp that was the case. Again, consensus 132,000. No expectation for an uptick in unemployment. So an uptick in unemployment would be a surprise. But let me ask you guys. Absolute beginner. I'm laughing at that Venezuela joke. Somewhere somebody gets my sense of humor, like this dry sarcasm. And if you get it, these are just for you. It's going to go not over their head because it's not very sophisticated or intelligent, but it's going to go right by 95% of the people. But a couple of you are going to snicker while you're listening to this. But here's my question to you. If there's an uptick in the unemployment, and remember, the summary of economic projections put out by the Federal Reserve expects, whatever that means, the unemployment rate to get up to 4.4% in 2024. Right? And we only got a couple more payrolls reports until the end of the year, and expects for all of 2025 that 4.4% will be the high. I don't think that's true. I think we'll be somewhere closer to 5%. And that's just a guess. But if we see high upticks in unemployment, I am curious whether you guys, ceteris paribus, single factor alone, do you think that's bullish for equity assets or bearish for equity assets? I want to see what you guys think. Again, the question is, would a slight uptick, so a surprise uptick in unemployment from 4.2 to 4.3%, would that be net bullish for equity risk or bearish for equity risk? And my answer is actually counterintuitive. That's the reason I'm asking. So let's see what you guys say. I'll give you a beat to type in your answers, and I'll come back to this in just a bit. But the other potential here to spark something in the yield curve would be an unexpected increase in this average hourly earnings month over month. So the expectation is that your wages go up by about 0.3%. In the last report, it was 0.4%. If there's a surprise uptick in that, what does that mean? That means more purchasing power amongst the proletariat, and more purchasing power means potentially upward bias on prices, and that could potentially be factored into the yield curve or create a little bit of volatility into the treasury market. I am stumbling over all my words today, and I do not know why that is. So let's see what you guys said. Hawk Run says uptick would be bullish. VDub says bearish for now. Sterling says will be bullish as it would accelerate rate cuts. Very, very smart analysis there. Absolute Beginner says bearish, question mark. I love that. Baba, what's going on, Baba? Great to see you. Says bearish. Kimberly, thanks for being so active in the chat today. Appreciate it. Makes it fun. Says bearish. So my and Meta says, hate to say it, but net bullish because less dead weight from cynical court perspective. Boom. I sort of think a surprise uptick in unemployment would be bullish. Because why? Because one, we're below 4.4%. So the Fed has already told the market to potentially expect 4.4% unemployment. So in some way, it's being factored and priced into everything you see in your screen right now. It's not fully discounted as if we're going there, but at some level, there's price discount of that already. That's number one. Number two is higher unemployment is to Sterling's point, I think would create more speed on the rate cut scenario. So the higher that thing gets going, the more pressure there's going to be on the Federal Reserve to respond. And then also, higher unemployment in the short run actually just means that corporations are cutting expenses. So as long as that doesn't do anything in the short run to revenues, it actually means expanding margins for the ultra short term. So in a weird way, I would be careful about thinking about higher rates of unemployment as insta-bearish. I wouldn't think about it that way in this particular environment. That's my personal opinion. I could be totally wrong, but that's the way I'm thinking about the world. Sterling says, my question for you, Victor, is this. Does the market believe jobs numbers anymore after over 1.2 million revisions down in the last 12 months? I don't know if the market believes it, Sterling. I can just tell you what I think. I don't believe that the number is right, but it's the only number that we have to trade. So it's like if we're playing poker, and the turn card comes. We can argue over whether or not the dealer dealt from is dealing from the bottom or something like this. It's probably not a great example, but at the end of the day, we've got to play the card that was flipped. And so I think that would be my response. I don't know that anything is like the narrative is they're purposely that they're purposefully misreporting the payrolls information. I don't know that I don't know that I believe that. I don't have any evidence to believe that. I do know that I think there's a better way for us to have a more real-time understanding of what's happening in the labor market, given the fact that we have payment processors and we could just go straight to the source like ADP. We could go straight to the source to sort of figure this out, but we have some weird convoluted way of this model where we effectively just add 50,000. If you go look at the numbers, the birth death model basically just adds 50,000 jobs. And and that becomes a real problem when there's vol to the economy, or the economy does something quickly or changes directions. That birth death model either underreports or overreports, and that becomes problematic. And I think the economy shifted. I think that birth death model had a real impact into the numbers we saw every day, but it's the only number we have, and so we got to trade it. That's my answer, Sterling. A little bit long, but I will accept the poker analogy. Thank you. All right, I'm going to get off this screen, producers. Just giving you a heads up, I'm going to go back to the platform. I know you guys are doing some cropping, and I do understand why. Too much white space. I appreciate what you guys are doing. Just giving you a quick heads up. I am now flipping to the platform. So follow me there, my good friends, and great work.
Thank you.
Market staying. I can tell it's you, Matt, because you didn't go. Thank you. Which would be
I can get closer to the mic if you want, but I don't think the viewers want that.
Thanks, my friend.
Also, it is just me now.
All right, good man. So basically, now that we've got this like extra long show, we've got 90 minutes, and we are now into that the extra 30 minutes here. Matt's the only one that's hanging around with us. I want to talk about a couple of things you guys are talking about, which is bullish above 5,700. Everyone is sort of talking about this level, and it played an important role today. 5,750 played a really important role. We'll give it some time to come up. So for various reasons, whether it's technical or whether it is basically the option positioning in the marketplace, 5,750, or let's say 5,700 for some people, but let's just call it a range because I don't think technical analysis works by to the penny. But the point is, within that range, that's sort of this line in the sand for bullish sentiment, bearish sentiment. And in a violation of that range, we could see the gamma of the market shift, and it could see the sentiment of the market shift with a violation of 5,700. So I want to call out who said it. I can't. I just lost it in the chat. But whoever brought up the 5,700 number, I appreciate you doing that. But yeah, I think it becomes really, really important. And the really interesting thing today is it played perfectly off that 5,750 area. We came down. This was sort of a value area, and the market ate up risk instantly at that level. And I think, I think it basically strengthened the reliability of that being an important level today. I think it's one day we can sort of see it on a longer level. You can see the very simple, John Murphy, technical analysis that previous support becomes, or previous resistance becomes future support. So 5,700 was this real, we were in this area for like 2 or 3 weeks, couldn't violate it to the upside. We eventually go back down. This is the yen carry unwind narrative, right? Market buys up risk. We pass through 5,700, and so it becomes likely a big line in the sand for sentiment from the technician's point of view on any weakness. So I agree with that. So let me go back to the Chinese stocks, if you guys don't mind, because I think talking about the setup of coming into this week is one thing, but I think the question now becomes, how do you play these things? How would you play this? How would you play these names with an incremental dollar? And I think that's a tough one to answer, but let's try to do it here. The IV rank of these names. Look at the IV rank. 101, nearly 102. Individual implied volatility at 42%. So basically saying that over 1 year's time, this thing could cut in half. FXI could be trading it back at, $16? Or it can add $16 to the upside, that we could be trading 48, between 16 or 48 in a 1 year's time. Why? So I think this is important, right? Like I thought about this. I think about this every time I want to put a collar on. Why do I want to put a collar on? I want to put a collar on because I've likely just made a lot of gains in a short period of time, and I want to protect the gains of that move. So what do? You want to buy puts on that position in order to protect downside. And maybe you'll sell, like all the tasty traders we try to make, if we have capital outlays, we got to pay money, we want to minimize our basis. So we might sell something against it to make it cheaper, and that's the collar. But the point is, after you get these big runs, it's not uncommon to see vol go up. But it's counterintuitive, right? Because you're thinking the stock goes up, then that means vol goes down. Well, in this case, stock goes up so much that what are you likely to see? You could potentially see with every incremental dollar, somebody goes, I don't want to buy this stock because it just had this massive run. So what do I want to do instead? I want to participate in the upside with minimal capital risk on the downside. So you start seeing call options get bid up. And if you're long the stock, you want to buy puts to protect your position. And I think what you're seeing here is you're seeing increased demand for protection and for upside participation. And that's creating an expansion of vol. So I actually think the way that I would look at this, if you're not in any of these names, if you're not in FXI or Alibaba or Baidu, to me, the bid in vol in all these underlyings makes it really, really interesting to sell puts as a potential entry. Because if you do get a big pullback, that violates your short strike, you get a decent entry discounted by the amount of premium you take in. So you're not going to pay top dollar where we are now. And if you don't, you're going to take advantage of this massive bid for option premium right now, which is the whole game that we play here at Tasty. So to me, these instruments everyone's going to talk direction, right? Because they went up 20% in a week. FXI went up 15 to 20% in a week, so everyone's going to talk about them this week. But because they're talking about them, they are bidding up the demand for options, and that creates opportunity for all of us. And so I think these are the most interesting vol selling names this week. Let's see what you guys are saying. Daniel, good to see you. If it's a story, it's a fade. A reference from Tom last week. Again, I think these things could fade. I think they could fade. However, I do think over a long period of time, if we are in a rising liquidity, a market of rising liquidity, I just don't want to trade these things to the downside. I think there are some things that I want to participate on both sides of a market if I think they're close to fairly priced. I don't think Chinese stocks are anywhere close to fair value. All of these things, if you look at their forward multiples, or you look at them relative to their U.S. counterparts, they're nowhere close to being in the same ballpark. And if one day or 1 week or 1 month they want to price these things closer to fair value or closer to fair relative value, we're not close. And that's the reason I don't really want to play the short end of these things. I want to look for opportunities to get long into discounts. But that's just me. I might be wrong and these things could cut in half, but that's the way I'm thinking. I wouldn't fade these things. I think you're just asking to get murdered. You might, and by the way, you might make money. I'm not saying you can't make money on the short side. I'm just saying for me, the risk to reward doesn't, to me, I feel like it's picking up pennies in front of a steamroller. You might get a few, but, there could be a time that comes when you're like, why the hell did I even try? Collars are friction. How much are you willing to pay for a collar? Usually I'll do them at a credit reso. Like I'll sell something 45 days out and I'll buy something with maybe a few weeks. So I don't tend to do I calendarize the collar. So usually I'm doing them for decent credits. Let's see. FXI has 2 pullbacks before next advance. Yeah, I totally could see this thing pulling back, but for all the reasons I just mentioned, I would just be careful about fading. Maybe I wouldn't add, maybe I wouldn't add to a position at certain areas, or maybe I'd lighten up deltas. But on certain areas of the marketplace, this being one, I just don't want to be short some of these things. And I'll tell you why. You want to know why? Because the Venezuela charts. Because of stuff like this. This is, I don't know. I wish when I look at this, man, I see something very different than what other people see, I think. That scares the hell out of me. And apparently it's not even a story. But let's keep cruising, everybody. What do I want to talk about? Oh, yeah. So the other one I wanted to bring up really quickly, the other article, the other theme in the marketplace, so to speak, is the nuclear. We got a bit of an advance here after being weak. Some of the nuclear stocks were weak at the tail end of last week relative to other parts of the market after they just went on this nasty run. Let me pull them up for you again. So the ones that we are tracking are CCJ, which is the largest, one of the largest uranium providers. So this is $48, and this has had a nice little run off of 36. The other ones we talk about, this is a higher beta play, and this thing just trade. If you're looking for a really leveraged, I don't want to say leveraged, a ton of beta to trade nuclear themes. This is an interesting one. This is a small SMR, so small modular reactors. And, this one has had a sick little run from 7 up to 12. Again, these, I don't understand. Nobody talks about these underlyings. Everyone's talking about NVIDIA all day long. And NVIDIA might move from like 115 to 120. Meanwhile, these other themes, these stocks are doubling, right? These Chinese stocks have gone up 50% off of their lows. FXI is up 50% off of its lows. New mining is at all-time highs. But nobody wants to talk about anything except for AI all day long. Sorry, I'll get off my soapbox. So NewScale, CCJ, URA is an ETF that sort of tracks a basket that's all related to these themes. I don't love it. I think it's a bit expensive, if I'm not mistaken. I do own it, but it's not the cheapest instrument. So the point is, we had a lot of movement on this theme over the last couple of weeks, and I don't think that's going to stop. So Microsoft bought, what was the company? How did I already forget the company? Microsoft bought an energy company, an energy name. They're reopening 3 Mile Island. There's all of these sort of movements to sort of accept that if we're going to power AI and we're going to build these gigantic data centers, well, we need energy. We need to power these things. If we are going to have digital money, CBDCs and stuff like this, every time that whole network is going to take energy. If we're all going to drive around in electric vehicles, we need energy. You know what I mean? It's so obvious. It's so obvious that we are actually headed to this world where we're utilizing AI to the extent that the narrative's being sold, and if we're going to use central bank digital currencies or digital currencies, it's going to proliferate. We're going to drive around in EVs, man. We're not even close to being able to power this stuff. They just shut down power in California. We can't even power what we've got right now. Anyways, so Michigan nuclear plant finalizes federal loan to support first reactor restart in U.S. history. This was in Covert Township, Michigan, $1.5 billion loans. And I just think we're going to continue to see this. We're going to continue to see articles like this. We're going to continue to see it's sort of like foaming the runway. It's getting people comfortable with this idea before, and now we've done it in individual municipalities and individual states. So we get comfortable, and then we pass something at the federal level. That's the last thing to happen. And I think we're in a process of watching that all unfold. And for that reason, some of these uranium names are really paid. And it's been paying to buy volatility in these underlying names. And I think we'll see that. Energy prices will go to zero in 20 years. This is from Baba, or less, unless regulators protect incumbents. I think the production cost of energy will go to zero, Baba. But it's like capital. To me, I think the way to think about it, Baba, is like it's kind of like money. So some people's cost of money are near zero or inverted, right? They just have positive carry. But most people, but large institutional players' cost of money is nearly nothing, whereas the cost of money for most people right now is, depending on maturity, somewhere between 5 and 6%, and on unsecured loans, up to 30%. So I think we probably get to a world where the cost of energy has variable pricing, that's just spread between what the cost of production is and the cost to everyone else. It just ends up looking a lot like the cost of money. Let's see here. What else do you guys got? Should rephase energy production cost will go. Oh, you did rephrase it. Should rephrase energy production. you you literally said the exact same thing that I said, and I just didn't read the next comment. That's funny. Daniel says it's always important to define time horizon on trade ideas. For example, Tom was saying the dollar is dead to Ilya's long dollar call. Look at today's euro pair action. Yeah, I think when Tom says the dollar is dead, he's not saying today or tomorrow or this week, right? When Ilya says he's getting long or short dollars, he's talking about hyper short term. He's talking about, literally on the charts this moment where price is, how he would position risk. I think Tom is looking at it very differently and just saying that he sees over time a weak dollar. And I think that's in the same way that when he was going long yen, he wasn't saying the yen's going up to tomorrow. He's saying that the risk to rewards favors buying yen here. In the same way that when he was accumulating Chinese stocks maybe a year and a half ago, he was just saying they're the cheapest bargain in the marketplace relative to other instruments. And I don't think he's wrong about any of those things. The question is, when is the catalyst coming that could spark the move that you need to pay you off on the risk? And I think depending on the amount of leverage you're using and depending on the amount of capital you have, you might not necessarily care if you're on the precipice of a catalyst, right? If you got a lot of capital, you can afford to say, I'm going to buy up yen and eventually this is going to pay. That's what effectively what Warren Buffett does in value investing is all about, right? You buy what's cheap, and you don't care that the catalyst may come tomorrow or 2 weeks from now or 2 years from now. You're buying what you know you're getting a value for, and that at some point in the future, you trust you'll be able to sell that at a premium. I think that's the way Tom thinks. Whereas I think many others in the active participation game, if you get a negative or adverse move inside of 2 weeks, depending on how you trade, that can hurt you. Most people are trading with their size is too big. And I think Tom's size is small relative to, the chips he's got at the table. And so it's small enough to sit on this stuff for years. And so it's time horizon, but I also think it's bet size that is important as well. How do I think about the dollar? I personally tend to agree with Tom. I think that I think the purchasing power of the dollar, we're about to see it erode, in my personal opinion, at a speed that we've probably never seen before. And we've already seen that happen. And I think unless we're willing to embrace pain as a society, it probably continues to happen. It happens at a speed we're not ready for. That's my personal opinion. But currency pairs are all relative. And the way the monetary system is set up, that doesn't necessarily mean the dollar is going down relative to the euro. And, pick your pair. So I think the dollar's purchasing power is going to erode at a speed that I don't think people are ready for. And I also think that that's why you start to see, the more we stay on this train and we don't do anything about it, the more we keep seeing stuff like this and stuff like this. And so if we're measuring our economic success by the nominal price of a risk asset, then politicians are they're going to get straight A's. If President Trump and President Biden tended to measure their economic success with the price of a risk asset, the price of the stock market, and if that's what we're going to do, that's how we're measuring economic success, everyone's going to get straight A's from here on out. And I don't know if that should be the measuring stick anymore. And we're finding out why that is right now. I think it's becoming more aware to the people how this system is working, and it's benefiting asset owners. Of course, it's not benefiting those that are wage earners solely. And we either need to get more people as asset and risk owners, or we need to, I don't want to say need to, or perhaps we continue to see social volatility manifest itself in the absence of financial asset volatility, because that's what we've done. We've essentially exchanged financial asset volatility. We do not want it, and so what do? We do all of these sort of magic monetary motion or actions, and that action protects the growth rate of GDP. But there is an externality of that. So we're protecting financial asset volatility, but Chris Cole said volatility cannot be destroyed. It can only be transmuted. So the transmuted volatility goes away from financial assets, but it manifests itself in social volatility because the method that we're using creates increasing wealth disparity and inequality. And eventually that wealth inequality shows up, rightly or wrongly, as people believe things aren't fair, rightly or wrongly. I'm not here to have that discussion. And then you start to see populist periods, populist government, populist policies. And I think that's where we are right now. Anyways, that was a long diatribe there. Sorry to get on the soapbox. Bitcoin, though, peeling off of 65. We picked up a little bit of that from, I think, 55 to, I can't remember, 57.50 or something, maybe closer to 60, and then this thing started to run to 65. So I'm just sort of praying that we get another chance at 57.5. This is another one. I don't want to get caught short Bitcoin, not in this environment ever. I want to buy it when it's cheap and maybe sell it when it gets a little bit expensive. But this is another one I think could hockey stick crazy. And I do not want to get caught short this instrument. Let's see here. Let's take as many questions as I can with the last couple of minutes. Yen is weakening again as well. I'm in the dollar rally camp. Daniel. Yeah, I think in the short term, we need the dollar to rally in order to, it sort of will minimize the impact of rate cuts and easing QT, which is likely to be the next step here, right? After rate cuts, it's easing of QT. So I do think in order to offset reaccelerating inflation or the pain thereof a stronger dollar will help. And so I think that's likely to be the goal. Whether or not it plays or not, I don't know. Clueless but interested in learning. I'm with you. That's me too. I think it's good for all of us to think of ourselves that way. Geothermal becoming very real too. The other thing, I know I talk about nuclear energy, but nuclear energy is sort of like very far out on the time horizon. The more likely solution to a lot of this stuff is going to, the short-term solution to a lot of this stuff is going to be natural gas. Natural gas is the bridge fuel. Nuclear is sort of the long-term bet. But I don't think it would be that crazy to start looking at, natty gas companies as well as an energy solution. Silver, I am long silver, which seems crazy, because I think in the short run, we're probably a bit extended at 32. This is going to be an area we're likely to see, some level rejection. What's up with my keyboard sometimes? All right, let me try this one more time. Nothing. Okay. I swear I have used this before. First day with my new fingers. This thing is... All right, this thing doesn't want to play ball with me. I wanted to look at the continuous contract here. If you were at home, if you put a dollar sign in front of a future symbol, when you look at the future symbol, you're going to look at one individual expiration. So /SI is silver, Z is December, 4 is 2024. So we are looking at silver's December 2024 contract that expires at the end of the year. But sometimes if you're looking at trend of an instrument, it's better to use the continuous contract instead. So it will use whatever's the active expiration across your entire chart. I'm trying to get to that, but for some reason my keyboard's not working. But that's not the point. The point is 32, it's likely to be this area where we could reject before violating it to the upside, if that's ultimately where we head. If the dollar either stays or continues to weaken, we could and may violate 32 to the upside. If we strengthen here, it wouldn't surprise me if we see a rejection off of 32 and you're able to play the long side of silver a little bit cheaper. So here's what I'm doing. I actually bought some out of the money upside in silver, out of the money call spreads. And so the idea is, again, when things get to price extremes, but I think there could be a breakout, I don't like to own the underlying, especially a leveraged futures contract like silver, even the micro or even the mini /SIL. I don't want that type of risk here at a resistance area. So I buy out of the money call spreads to the upside in the event that we get follow through and breakthrough. But in the event that we don't, I have minimal risk on the table, and then I get a cheaper price to play something. If we got back sub 30, I would probably then do something more bullish. So like at the money or in the money silver options, or just play the futures outright themselves. So that's the way I play this. So I'm firing some bullish bets, but very small in the case that I'm wrong. And then if I get cheaper entry price, double down with a more leveraged bet with more capital, more risk. That's the way I'm playing it. Use AI, Victor. Your stock value will go up. Let's see here. Honestly, as AI takes off, inequality will increase exponentially. I believe it's the morally wrong avenue for humanity. Daniel, man, you would drop that truth bomb 1 minute before the close. 1 minute before the end of our 90 minutes. So I'll give you my quick thoughts. And Matt, the producer, is going to be pissed off if I go long. He's like, bro, we gave you 90 minutes and you still couldn't end the show on time. Here's what I'll say, Daniel. Here's what I'll say. I read a book by Kevin Kelly. It's called The Inevitable. And in that book, I think it's in the first chapter, he said something that really resonates with me. He effectively said that you cannot stop the advance of technology. It's kind of what we do as humans. The technological advance becomes inevitable. So while there's a part of me that does agree with you, I do believe it's going to be deflationary. I think it's going to create it's much less labor force participation. I think it's going to concentrate wealth and power even more so. I also believe it's inevitable that no matter how many times we run this game back, we probably keep ending up at this point, either sooner or later. And I also think no matter how much we try to legislate it, let's say the U.S. right now, we just outright ban it. Well, the knowledge of how to do that becomes extremely valuable to a country outside the U.S. So there's a number that somebody is going to incentivize some person or some group of individuals to come over and monetize their knowledge somewhere else where it's not illegal. So I just think when you think about the game theory behind or the incentive behind this stuff, it's no matter how you look at this thing, it's going to happen. And so then I think rather than fight it, or sort of be fatalistic or upset about the direction, you sort of have to embrace what it is and figure out how to best position yourself in that future world. And so there's a part of me that agrees and empathizes with your position, and I struggled with this for the last 2 years, this thought of how to think about technological advance when it's happening at a speed that could create societal volatility. And the end place I got was it doesn't make sense to fight it. It makes more sense to try to figure out how to best position myself and my family in that future, for rightly or wrongly. So leave me a comment in the comment section. Tell me how you think about AI, its impacts on society, and its impacts on you, and whether or not you choose to embrace it, accept it. Do you believe it's inevitable, or do you choose to fight it in some way, shape, or form? I want to thank all of you for sticking around for 90 minutes. I don't know why anyone would listen to me speak for 90 minutes, but I'm hoping there's a decent audience of people that want to do that from here on out. Tomorrow, we're going to have Chris Vecchio on for a 60-minute conversation. Then I'll get to talk to you for an additional 30 minutes. On Wednesday, Ilya and I have decided to extend our conversations to 90 minutes, because usually we've got a lot to talk about. We don't get to all of our points inside of 60 minutes. So I'm looking forward to this extended period of time with you guys. Hopefully you enjoy it as well. Feel free to hit me up on Twitter at Victor Jones. The Owen Jones is 0 because I like to be difficult. If you have additional topics you'd like us to cover, feel free. I've got a ton more time to expand on individual topics. I'm happy to do so. Hit the like button on your way out of the door. I appreciate you. We'll see you back here, same time, same place, same great network, only on Tasty. Peace.
No more 50 basis point rate cuts. It's not a bad thing. It's Monday, September 30th, 2024. This is Overtime. I'm your host, Chris Vecchio, Ilya Spivak in San Francisco, Dylan Radigan in Milan, to take us through the rest of this hour as we wrap up the trading day. And hopefully for the Mets to close out the Braves here. Diaz, stop blowing it. We do have to focus on these markets, though. And it's a market that ultimately turns higher into the end of the session. End of quarter markup for the S&P 500 and the NASDAQ as they briefly turn their heads above water into the close. The final half an hour did see a rally here. S&P 500, as we turn to the charts, 58.14 and a quarter. NASDAQ up by 0.14%. Russell up by 0.11%. And the Dow Jones slightly lower by 0.12%. Until that final hour of trading, though, it was a quiet day. Powell's comments did move the market ever so slightly, with a brief pullback in equities spurred on by the whole idea that maybe we're not going to get another 50 basis point rate cut in November, which was the base case scenario. We see all the news out of China, more rate cuts, more stimulus, silver, gold, copper, they all take a break. Some really incredible news out of the Middle East this weekend. Just eye-popping headlines left and right, and yet oil still can't catch much of a bid, 0.03% higher. And then in the world of currencies, the yen, that is taking a move to the downside, still digesting the Ishiba, perhaps, results, off by 1.02%. Gentlemen, it is the end of the third quarter, though. We finish the quarter with another 4% gain in the S&P 500 for the quarter, 7 out of 8 quarters in a row in which that's happened. It also means that we had the first positive September since 2019. We're closing the quarter at an all-time high in ESZ4, not the all-time intraday high, but the all-time closing high. And so when people check their 401ks, when they get ready to see what their financial advisors were doing for them, they're going to go home pretty happy. Ilya, what's the bear case from here henceforth as we go into end of year where the market's up 20% year to date?
I think you have to look at the way that the S&P has performed the past 3 weeks. Notice that it's performed slower every one of those weeks and ask yourself why. So the biggest week that we've had was the second week of September. It was a massive rally. That was, of course, the week that the markets moved to bake in the 50 basis points from the Fed. We saw massive positioning for that bigger easing after the CPI data. So CPI data came out. It was in line. Market said, smaller cut. And then within 48 hours, they said, no, bigger, because this is what we want. The following week, the Fed delivers. Markets are happy, but the rise is shallower. This past week, China unveils all the stimulus they could possibly muster. Markets rise again, but shallower. And so you ask yourself, okay, why? Which part of this don't the markets like? They're getting absolutely everything they want, and they're getting it at a time that U.S. economic data is getting better, not worse. What's going on? And you notice that the markets read the Fed as reflationary. We've talked about this a lot. Gold has been screaming. The curve has steepened. The dollar has been lower, all of which means fewer cuts in 2025, maybe. And then we get Powell today, and he comes out and gives basically the speech that we were thinking he might give last week, where he basically just didn't say anything. And he pushed back and said, it's two-sided risk. We're not on some sort of course that's already set. We'll give you the 50 basis points we said we'll give you in November and December unless something really odd occurs. But we're not on any kind of an accelerated timeline. We don't feel like hurry. We're not cutting to address any sort of weakness. Everybody be cool. And all of this means that maybe 100 basis points is too much for next year, and maybe the markets just have already baked in everything that there was to bake in. And now we just get distribution into the end of the year.
Dylan, coming into 2024, the market was pricing in 6 rate cuts. And we heard time and again from the Federal Reserve that we weren't going to get all of the honey, all the sweeteners that we wanted. And yet, during the time when the market was pricing out those rate cuts, the equity market was still able to trudge higher.
Right.
Are we going back into a first half of the year redux, Dylan, with the super glide sitting in the control seat?
Again, I feel like this is a weird sort of role reversal because basically since, I don't know, for a couple of weeks now, I've been the one who's been more than the Vecchio let it ride Chancho. Yeah, I think we're in an incredibly good position. I think that the labor market is in a great, and the only pushback I get from the Sosnoffs and Spivaks of the world, and it's not much of a push, is valuation. No one can argue even that the labor market's great. The tech innovation sort of super cycle is intact, to say the least. The rate directionality is the right way. It's beneficial to more than the tech sector, meaning, all the sort of housing related, housing adjacent, rate adjacent things, throw into that the Chinese money bomb and the commodities bump and all the rest of it. The only reason you wouldn't play is because you have an opinion on valuation, which is sort of where we've been. And I would say it's getting better, not worse. Meaning that the valuation relative to expectations is getting better, not worse. We're going to come in now. We're going to go into the fourth quarter. Tomorrow's October 1st. You guys gave me a bunch of Chinese skepticism last week. Don't think I didn't hear what you were saying. You're all giving me the hole in the bucket and the structural and the lack of demand. I heard you. And I'm not saying you're wrong. But I'm saying, it's not nothing. It's not nothing.
Aussie dollar says we're right.
Yeah, I mean, listen, as a euro based, somebody who lives in a euro economy, I'm happy with the euro situation. So I never complain too much about it. But, listen, there's always not always, but there's for sure some warts and some flaws, some flies, some issues. But I'm a buyer. I don't know what to tell you. I think this fourth quarter is going to be a beauty.
I think one of the interesting things to kind of build on what you just said, Chris, it took about a month at the beginning of the year for the markets to basically say the data is getting better and we're losing rate cuts, but we're losing them for a good reason. We're losing them because the economy is stronger and doesn't need as many cuts. And it took about a month for the markets to basically decide, okay, we're going to build higher on this. January was mainly spent on digestion. So if you look at what was going on there in January, you can see you hit something of a peak in, and we'll use just the S&P 500 as a benchmark, right basically at the turn of the year. December 28th is the swing high. You don't then make a new swing high until you get into the last week of January, first week of February. So there's about a month in there where things get dicey. So it may very well be that this time the markets go, well, the data's getting better. Maybe we need fewer cuts, but maybe that's a good thing and not a bad thing. It might take a while for that to kind of shake out. But of course, assuming similar timelines, that puts us right into the election and makes for us something of a different sort of atmospheric background, if you will.
This was such a strong performance for the month of September, for the third quarter, and really for the year so far, that it begs the question, how much further can the market run? Technically, obviously, you have one perspective that I've outlined, but I suppose it's worth looking at it from the quantitative side as well. It is an election year, and so while the S&P 500 and NASDAQ both have fairly strong returns, historically speaking, over the past decade or 2 decades, in the month of October, we do need to be aware of the fact that going into the election, right, depending upon which party is winning the election, the market behaves differently. So the month of October could actually be very instructive for how we anticipate that result on November 5th. Going back to 1927, going back to 1927, 1928, the month prior to all elections, when the incumbent party has retained power, the S&P 500 has gone up 1.9%. Leading into the election, if the incumbent party loses power, stocks are down negative 0.4% on average since 1928. But I want to dissect what happens in October after a 20% gain here year to date so far. This is the 10th time since 1950 that we've been up 20% year to date going into the fourth quarter. On average, October has produced a return of negative 3%. When you go into October with a 20% year to date gain thus far, median return is minus 2.5%. You are lower to the tune of 77.8% of the time. And that's interesting because on average, the month of October, going back to 1950, you're gaining 0.9%, going up 59.5% of the time. So the fact that we're in a presidential election year right now, when markets tend to get a little bit dicey in the month leading into it, we can perhaps read through to find out whether or not which candidate the market believes is going to win by how the market behaves into that result, depending upon the incumbency bias. But if there's a slog here in October, I don't think it should come as a total shocker. Not that seasonality was a great guide for September, at least after the first week of the month it wasn't. The first few days it was a great guide. Even so, though, if you have a bad October following a 20% September, fourth quarter returns are still positive, 2.1% on average, higher 77.8% of the time. So I guess what I'm getting at is, given the accumulation of everything ahead of us, if there's any weakness in October, it is a buy the dip kind of environment. We got all that Chinese stimmy money going burr. We have the Fed cutting within 2% of all-time highs. And even if there's a setback, which would be fairly normal here, it's not necessarily a setback that you want to sell the farm for. It's a setback that, if history is also a guide on the other side of October, you want to look for an opportunity to get long again and sell any volatility spikes that we see with vigor.
Only thing to remember here, of course, we don't have the Chinese stimulus that everybody hopes for. So far, it's only hoped for. Right? The big news in Chinese stimulus is that they're getting ready to do fiscal policy support, without which any of what they've done so far is going to work or has worked for years. This is not the first increasing of Chinese easing provisions. They've certainly done more in one shot. They did the bank requirement ratios and the headline rates all in one go this time. They usually take turns. They spent a bunch of money, or want to spend a bunch of money, on boosting stocks. Fine. But all of that is completely window dressing unless there is fiscal stimulus. And what the markets really took with such optimism last week was the idea that the Politburo is finally ready to do something like that. But there's no numbers on it, no concrete plans around it. And the whole idea that they have is that they're going to hit their annual growth target, which they're currently missing, and it's the beginning of the fourth quarter. So if they don't start raining money on this economy, basically like now, and I do mean demand generating, not just here's some cheaper credit, maybe now you'll think to actually do something. All of what we've seen out of China for the better part of 2-3 years says people are not spending and won't. Hence the 5 quarters of deflation. So the question now is, where is the fiscal stimulus and whether it'll come? And I was alluding to earlier, the circumspect performance from the Aussie dollar and the rapid reversal in copper seems to kind of reflect some of this. I mean, copper looks absolutely scary.
Yeah, copper had a fun day today.
I mean, look at the violence of that reversal. It hit that previous high. It went quite a bit of a ways higher, all around that China story, of course, and then got absolutely walloped back down. and the Aussie dollar, which should be up, hawkish RBA, dovish China. What possible reason would the Aussie dollar have for this level of circumspect waiting? It should be soaring. So the markets are suspect here, and rightly so.
Well, volatility is coming out of the Aussie. It's not coming out of the out of the copper contract yet, HGZ4, which as we frequently mentioned, probably a more tradable product than what you're seeing with silver these days in terms of liquidity, at least the futures options liquidity. It does bounce off of its 1 week moving average, and we are basically at the midpoint of the range high that you have going back to May and then low here in August, which at a 91.6 IVR. Look, volatility is really rich. This is an interesting spot to try to lay out perhaps something directionally neutral. If you had long deltas for the past 2 weeks, like some of us did, then do you want to make any adjustments here? No, not necessarily. But if you have enough time on your side and you can get some time on your side, then this is an interesting spot, I think, at least to consider something a little bit more range bound. I guess I'm doing that as well already in the Australian dollar, where I have some iron condors put on. But we are wrapping up another quarter here where we see bonds push higher. Yes, it's a little bit of weakness here today, and we are closing well off the monthly highs in both ZN and ZB. But it's the fifth month in a row where we've seen gains in both the 10-year and long end bonds, guys. That's the longest streak that we've seen in a few years, quite frankly. I think this is one of the trades where, yeah, it didn't work out the second half of the month if you were staying long, but if you were in for the duration of the month, you saw net gains overall. That weekly chart, the monthly chart that we frequently reference, it's not as sturdy looking as it once was, but there is still compelling case for a little bit of a turn here. And it's why if we're going to have any long bond exposure moving forward, keeping in mind the reflation trade working its way through the system, time is going to be your best friend still. And it's been that way for several months now, where if you've just been patient and riding this up, it's been working. And I think it's one of the things that we can continue to count on. Just time is going to be your friend. Maybe a sixth month in a row is hard to come by, but 5 minutes in a row being bullish, you're not going to move away from that until it breaks and breaks.
Well,
very
so as a bond,
I'm looking for a little bit of confirmation, but I'm in.
Yeah, Dylan.
I mean, as somebody who's been in this with you, Chris, for a couple months, and recently, obviously, less positive than the intermediate history, with expirations rolling in October, that'll be losers down because if they're put on a September roll. Would you roll them?
Yes.
I mean, my inclination is just to keep it going. Although I'll probably bring my strikes to it. Honestly, I think they're like 101s or whatever. It's a TLT situation, but I just bring the strikes down as far as I can tell and keep going.
Yes. So right now, the way that I'm playing this, Anton and I were talking about it on Futures Power Hour earlier. So 127, 129 long call spread, a little bit out of the money. Instead of doing this as a traditional tasty 45 in, 21 out, instead treat the 45 days right now as the roll cycle before you start to even get into the part where the part of the decay curve where you start to roll up the hill. So 53 days now, that would mean next week I'm going to roll out to the 88-day contract, which, having done the math earlier, if you're looking at the similar pricing, this is 127, 129, 127, 129 here, 609. You're talking about $6 and change in terms of theta burn, right, per day. If the bonds don't move and I ride this into expiry, it's going to cost me about $6 per day, max loss divided by days to expiration. The current position that I have on at this rate is about $8.25 per day. So you could just lower your risk and just buy yourself more time. It's not going to cost you significantly more. There is, of course, the roll that you have to deal with. But that's how I'm going to treat it. Anton had a really good idea there. Stop doing 45 in, 21 out. Let's treat the 45-day mark as the place to roll. And you know what? We have an 11.1 IVR. Let's take advantage of the fact that volatility is so low to get some cheap out-of-the-money call exposure. Because as we saw at the beginning of August, things hit the fan. Bonds go vertical very, very quickly. They get a ton of vol priced in. They get a a bit of call skew up there as everyone bids up protection. And so those out of the money calls escalate in a very handsome manner, I would presume. So that's how I'm playing it. Next week, I'm going to roll out to the December 25th expiry in the ZBH5 contract, which I can't believe we're talking about 2025 expiries then.
2030, baby. We're rounding the back nine here, heading to 2030.
Oh,
That's why
So if you
Superglide, baby. Self-driving cars, teleportation. I'm looking for some teleportation in all this.
Okay.
I'm no longer impressed with the AI self-driving car.
Okay, so you mentioned self-driving cars, and I did want to bring this up because this is obviously a stock that's been flying here. Elon Musk, love him, hate him. I don't know if he has anything to do with this recent rally. We've seen a stock market that's expanded to the upside, and the rotation you're seeing is that consumer discretionary is beginning to show signs of leadership once more. And Tesla is one of the biggest components of XLY, the consumer discretionary ETF. So this is part of it. But there's the other part of this that maybe we're just going to finally get something from Tesla that we've all been waiting for. Dylan, this month, that starts in 7 hours and 33 minutes, should be the month that we get Tesla's Robotaxi Day. 10/10 is the fabled date. Dylan, what do we really need to see from Elon Musk on October 10th to ensure that A, this isn't something that completely clobbers the stock, and B, because he is such a modern day P.T. Barnum, we're promising all these great things about the future, and while he's working towards them, not to discredit that, you look at FSD, a lot of the dates that he's said these things would occur, they haven't happened on those timelines. They're happening,
Sure.
just not as fast as he's promised.
Sure.
Should we be looking at the 90.8 IVR here and saying, yeah, we got to sell some call spreads here because there's no way Musk delivers?
I mean, I don't know if it's a call spread. I think you definitely want to sell something, just because how are the odds that this is overhyped going in are almost just implicit in Musk's very ethos. And so I just don't why, but is it a condor? Would be my only comment. Like I would say for sure you want to be selling vol, but you might want to be wide in the condor range more than you are directional. But I mean, it's dicey to pick a direction with this thing. I gave up on picking Tesla's direction years ago.
On the consumer side, I'm a lot more excited about Nike.
Why is that?
That is a very beaten down stock that appears to be breaking out, and it's got earnings this week. So rarely do I dabble in individual names, but look on this on a weekly chart and notice that what you have here is a down move with a clear sort of line in the sand. And if you look at the latest kind of leg of this from the latest swing high there, the last time you hit that yellow line down, you seem to be trying to break out, and you have that underside there, the former bottoms. And frankly, it's one of those things where, yes, it's been beaten down a lot, but the cultural currency embedded in this brand means that it probably doesn't have too much of a hard time finding its way higher if the overall consumer story is improving. And they have earnings this week, so we might get a catalyst to actually confirm some of this stuff.
Nike is a really interesting case study of how an arrogant company totally screwed itself. During the pandemic, they decided to switch to a direct-to-consumer model where they told retailers, stores that you would go see like at an outlet mall, you don't need to have our product on your shelves. We're just going to cut out the middleman here. And that worked for a little bit, right? They cut out some middlemen. They helped beef up some margins. But the problem is that now all these retailers are like, okay, well, we need to put something on our shelves. And so all these competitors came in. And so a lot of the newer shoe brands that you see people walking around in today, they got their genesis in like 2018, 19. And because Nike decided to pull their own wares off shelves because brick and mortar was dead because of the pandemic, all these competitors came in, and Nike has been mistreated and abused by the market since then because it was an extremely short-sighted decision. They have obviously had a big leadership struggle recently where Phil Knight, Tom's talked about this a lot. Like when you have a founder that sticks around, it's difficult for the new CEO to kind of do what they want to do. And so in this case, Phil Knight sticks around at the wings and Nike can't really recalibrate yet. So I would love to see the stock do well. I suppose we should say rest in peace to Nike shoe aficionado. He had his own line of shoes. Dikembe Mutombo passed away today.
Yes, indeed.
Ilya, where we're
the legendary Dikembe Mutombo.
Wow. That's too bad.
Brain cancer, age 58. Nike here, underside of the trend line, September 2022 low, the low that we have here in April 24. We're finding resistance here. Ilya, we get through $91. This thing becomes rocket up to 98, perhaps even 100, and then long-term basing. But you know what? That makes sense. This kind of looks like it's following bonds. Doesn't this look like the bond chart a little bit?
Looks a little bit like bonds, yeah.
It's almost as if people buy more athleisure wear when they're doing well and they're comfortable because they got money in their
U.S.
pocket.
bonds
the economy's
have
moving
cultural
and rates are
currency, as
low.
does Nike.
Right?
So there you go.
It's funny. Speaking of cultural currency, China released some, because militaries do. We do this too, but they release videos of like their fighter pilots doing things. One of the videos that they put out this weekend for like their propaganda, the fighter had a Top Gun sticker on his helmet. Like that's an American cultural victory.
Yes.
We're winning.
Yes.
We're winning.
Yes.
So,
if you had a Winnie the Pooh sticker on the other side, it would just be absolutely perfect.
Now this episode is going to get blacklisted in China, Ilya. Come on. All right. Let's go to Tesla. Dylan, okay. So
Mission accomplished.
We're up near the highs. We're up near the highs for the year right now in Tesla. Is this a phase?
That's why you're running call spreads at me.
That's why I want to know if we're going to be, this is the odds here. If we want to play this and play it tight, we're up near 270. We could do this with a lot of convexity and go into, say, 20 days because of the earnings announcement, I think is 18 days away. Let's see. What are we, 18 days away here? Yeah.
When you get elevated